Hello everyone. In today's video, I'll be covering 12 accounting standards and this is going to be a rapid revision video. So I'll be explaining only the concept here and few questions for better understanding. So this is going to be part 1 of CA Inter Accounting Standards Marathon revision video. So stay tuned for part 2. Okay, so without wasting much time, let us get into the video. So I'll not be covering the standards in the same order that I've written on the screen. So the material which I'll be using for this entire video, I've shared in the Telegram channel, and the Telegram channel link can be found in the description box. So please join the Telegram channel. The material is shared over there, so you can take the material so that you can follow the entire revision along with me. Thank you. It's going to be a rapid revision video. So I'll be trying to cover the important concepts only from examination point of view. Now, let us get into the standards without wasting much time. So accounting standard 1. So this particular standard deals with disclosure of accounting policies. And when I say accounting policy, what is the meaning of accounting policy? Let's say you're valuing inventory. So inventory valuation is something which must be done, which is a principle. And how do you value the inventory? There are so many options are available. You can follow either FIFO method, LIFO method, simple average, weighted average, all that. And this is what is an accounting policy, which is what you are supposed to do as an accounting principle. The method you follow is an accounting policy. So can we say an accounting policy is the method of applying the principle in preparation and presentation of your financial statement? And there are so many areas where you find different accounting policies when you prepare accounts. Let's say methods of inventory valuation. Can I say we have FIFO method, LIFO method, weighted average, all that, and valuation of fixed assets. See, as per accounting standard 10, you can either follow a cost model or revaluation model. These are the two different options available. Then valuation of investment. And when you are valuing investment, as per accounting standard 13, either you can follow FIFO method, LIFO method, all that. Then now, translation of foreign currency operation. When you are doing translation from foreign currency to Indian currency, you can follow either opening rate or closing rate or average rate. Different options are available. Next, treatment of retirement benefit, that is covered under accounting standard 15. We'll be discussing that later. So these are multiple options available. Treatment of government grant. This is one area where you find different options. So let's say you're receiving grant for purchase of fixed asset. You got two options. So either you can minus from asset cost or you can transfer to deferred government grant. So as per accounting standard 12, different accounting policies are available. Similarly, accounting for amalgamation. See, as per accounting standard 14, either you can follow purchase method or you can follow merger method. Methods of cash flow statement, either direct method or indirect method. So these are some areas where you find different accounting policy. Let's move on to the next topic. As per accounting standard 1, there are three fundamental accounting assumptions: going concern, consistency, accrual. I'm assuming all of you are aware of this particular concept. So very simple. So I'm not wasting much time on that. See, these three fundamental accounting assumptions, every business is expected to follow. Correct? Now let's say I'm preparing my accounts. We presume that these three assumptions are followed by us. We assume that the business is going to continue in the future. We are following same accounting policy every year, and accounts are going to be prepared on accrual basis. Okay. And let's say all the fundamental accounting assumptions are followed. Sir, if you have followed the assumptions, then there is no specific disclosures required. You need not tell the people that you have followed it. Because even if you remain silent, we assume that it has been followed. But however, if there's any deviation, then one special disclosure has to be given. So very important point. So if you followed the assumption, no need to disclose. But if you have violated the assumption, disclosure is required. Okay. Let's move on to the next topic. See, what are the different factors to be considered when you are selecting an accounting policy? See, when you are selecting an accounting policy, there are three factors to be considered. First one is conservatism. And this particular concept say, if you're anticipating any losses, you need to make a provision. If you are anticipating any gains, you are supposed to ignore that. Best example. So in case of inventory, you'll value at cost price or net realizable value, whichever is lower. That is mainly because of which concept? Conservatism. Similarly, you create something called provision for bad debt, provision for warranty. All that is because of what? Conservatism concept. Next, what is materiality? See, this materiality concept say, If a transaction is material, what is the meaning of material? The ability to affect the decision making of the users, so we call it as material. So if the transaction is material, then that requires special disclosure. But if the transaction is negligible amount, if the transaction is negligible, that can be ignored. So let's say you're buying some stationery, you're buying some pen, pencil, etc., etc. When you do that, will you account them separately or will you club everything under the heading printing and stationery? Everything under one heading. So this is mainly because of the concept of materiality. So if it is important item, you account separately. If it is negligible item, you can combine everything and account for that. Clear? Next. The next concept is very, very important, substance over form. Now this substance over form, this principle says, when you are doing accounting for any transaction, I repeat, when you are doing accounting for any transaction, you should give more importance to, just hold on guys. Okay. So this substance over form says, when you are accounting for a transaction, economic reality of the transaction should be given more importance. So what should be given more importance? Economic reality of the transaction is more important than the legal form of the transaction. See, our focus should not be on the legal form. Our focus should be mainly on what? The economic reality of the transaction. Now let's take an example. Let's say land is purchased and it is put to use on 23rd of March. So registration is getting completed on 7th April, that is in the next financial year. Now, when I'm preparing my books of accounts, land will be recognized in the books from 7th of April or 23rd of March. Now, if I look at the economic reality of the transaction, we are buying the land on 23rd March and starting to use also on 23rd March. And based on the reality of the transaction, the land will be recognized from which date? 23rd of March, even though registration is happening in 7th April, we will recognize the asset in the books as on 23rd March only. Similarly, one more example. In case of hire purchase, you would have heard finance lease accounting standard 19. So I've already made a video on accounting standard 19. You can refer to that video. So in case of finance lease, asset will appear in the balance sheet of lessor or lessee. Lessee. Sir, even though the legal owner is lessor, from accounting point of view, the lessee will be the owner. And this is again because of which principle? Substance over form. Okay. Now one example, if you look at the example, X Limited sold a building to Y Limited for 60 lakh. Gave the possession of the property also, can I say risk and rewards are transferred on 30th of September. However, documentation and legal formalities are pending. Okay. Book value of the building is 25 lakh. Since the legal formalities are pending, they are showing that 60 lakhs is advance. Is the treatment correct? So can I say, even though the legal formalities are pending, the possession of the property is already given. Sir, if the possession of the property is already transferred, can I say risk and rewards are transferred? And if the risk and rewards are transferred, if I look at the economic reality, can I say sale is complete? So if the sale is complete, can I show it as advance, or you cannot show it as advance? You cannot show it as advance, which is whatever treatment followed by the company is totally incorrect. So now tell me what you're supposed to do. What we are supposed to do now? So economic reality should be given more importance than legal form. And based on that, because the risk and rewards are already transferred to Y Limited, what we should do? The asset has to be de-recognized from your books of accounts, and you need to recognize the profit on sale of 35 lakhs. How have I got this profit? 60 lakhs is the selling price and book value of the building is 25 lakhs. So there is a profit of 35 lakh. I should recognize that profit immediately. Okay. So showing that amount as an advance is incorrect treatment. You have to book the profit immediately. And this building of 25 lakh has to be eliminated from your balance sheet. I hope all of you are clear with that. Okay. Next concept. Preparation of accounts on liquidation basis. A very, very important one from examination point of view. If at all there is a question from AS1, this can be tested. Now, normally when I prepare accounts, we follow something called going concern basis. And when we say going concern, what does it mean? We presume that business will continue in the foreseeable future. But let's say management is not confident about continuity. Let's say there's a major fire accident And because of the accident, I feel that business cannot be continued. And if you feel the business cannot be continued, then you need to follow something called a liquidation basis. You have to prepare accounts on which basis? Liquidation. And when you follow liquidation basis, assets will be shown at estimated realizable value. Very important. Sir, I don't consider the cost. I don't consider the book value. All assets will be shown at estimated realizable value. See, the logic is business will not be continued. So if the business is not going to be continued, assets will be maintained with me or assets are going to be sold in the market. They're going to be sold. And if the assets are going to be sold in the market, what is relevant for me? Estimated realizable value. Same way, all the liabilities will be shown at estimated settlement value. Remember these two. So assets will come at realizable value. Liabilities will come at settlement value. This is the point to be kept in mind. Okay. Now let's look at this example. There is some information given to you. Okay, one balance sheet is given to you as on 31st March 2019. Some additional information is given. They're asking you to prepare profit and loss account and balance sheet, assuming the firm is not a going concern anymore. And if the firm is not a going concern, we need to prepare accounts on liquidation basis. Now let's start. So opening balance sheet is given to you. Let's move on. Point number one. The remaining life of the asset is 6 years, even use. NRV of the asset, the realizable value is how much? 90. So when I follow liquidation basis in the balance sheet, I have to show the asset at what value? 1,05,000 or 90,000? 90,000. And in the profit and loss account, the difference between this 90,000 and 1,05,000, 15,000, I'll show it like a depreciation. So I hope all of you are clear. So in balance sheet, I'll show the asset as 90. In profit and loss account, I'll show the depreciation as 15,000. Okay, we'll move on. Point number two. Point number two is given to you. Sales and purchase is given to you. Sales will come on credit side. Purchase will come on debit side. The cost and NRV of the closing stock is given to you 60,000 and 66,000. Very, very important. Sir, when you are following liquidation basis, there is nothing like cost or NRV, whichever is lower. All the assets have to come at which value? Realizable value. And what is the NRV of the stock? 66. Which is when I prepare my balance sheet, I'll show the stock as 66,000 only. Okay. This figure of 60,000 is totally irrelevant. Next. General expenses, including interest on loan, 53,800. Where will this come? Profit and loss account, debit side. Next, deferred expenditure is normally amortized over 5 years, starting from the year 1819, 6,000 per year. Okay. So, what is the meaning of deferring? So, deferring means spreading. So, spreading is possible only if you are able to continue the business over more than 1 year. But in our example, business is going to be liquidated. So if the business is going to be liquidated, you cannot defer. So what I'll do, the entire 24,000 will be transferred to profit and loss account. Balance sheet nully, your deferred expenditure is going to become zero. I hope all of you are clear. So entire 24 will come in P&L debit. Balance sheet it will going to become zero. Next point. Debtors is given to you on 31st March 2020. Nothing but closing data 65,000. Out of that 65,000, 5,000 is doubtful. And collection of another 10,000 also depends on successful reinstallation of certain products. So can I say out of 65,000, this 5,000 is doubtful. And another 10,000 also depends on reinstallation of some product. So can I say this 10,000 also doubtful? Which means totally how much is doubtful? 15,000. So 65,000 data, out of that 15,000 is doubtful. So can I say 65,000 minus 15,000. So what is the estimated realizable value? 50K. So in the balance sheet, debtors will be shown at 50,000 rupees. And this 15,000, whatever is doubtful, that will be debited to profit and loss account. I hope all of you are clear. So in balance sheet, debtors will be 50,000. In profit and loss account, doubtful will be 15,000. It's 5,000 plus 10,000. Okay, next up. Closing trade payable, nothing but creditors, so 48,000. And this 48,000 is likely to be settled at a 5% discount. So can I say the estimated realizable value will be 48,000 minus 5% discount? So that is going to give you 45,600. So in the balance sheet, your creditors will be shown at 45,600. And this 5% discount, the 2,400 will come on profit and loss account credit side. Is that clear? Next, there is a prepayment penalty of 4,000 for a bank loan outstanding. So let's say you have taken a bank loan. And whenever you repay the loan early, there is something called a prepayment penalty. Because when you repay the loan early, bank will be losing the interest now. For that reason, they will be levying some penalty on you. And what is the prepayment penalty here? 4,000. And what is the bank loan? 80,000. Which means the settlement value of the loan, can I say 80,000 plus you need to pay 4,000 extra amount. So the what is the settlement value of the loan? 84,000. Which is in the balance sheet, my loan will come at 84,000. And this 4,000 rupee penalty will be debited to profit and loss account. Okay. And apart from that, what is given to you? Cash and bank balance is given to you 1,65,200. Prepare profit and loss account and balance sheet, assuming the firm is no more going concern. Okay, this is a very fairly simple problem. I assume you should be able to do this particular question. Okay. And one assumption we are doing, this 80,000 bank loan, we are supposed to pay 11% interest now. There's nothing but 8,800. This 8,800, you can assume it to be, okay, it's given out directly. General expenses already include interest on loan. So you need not take that 8,800 again. That is already there in 53,800. Okay. So the solution of this problem, I'm not actually working out because I'm assuming you can do this particular part. So with this, we have tried and covered important points of accounting standard 1. Okay, let us get into some important theoretical questions. Some true or false question. Fundamental accounting assumptions adopted in preparation of accounts require special disclosure. Definitely false. Because you need to disclose only if there is a violation. So if you have followed everything perfectly, you need not disclose that. Next, if there is a change in accounting policy whose financial impact is not measurable, disclosure is not required. Again, this is a false statement. So even though you are not able to measure the impact, you should disclose the fact. You should disclose the fact that change in accounting policy is there. So if you are able to measure the impact, measure and disclose. If you're not able to measure the impact, disclose the fact. You cannot completely ignore the disclosure. So this statement is again false. The next part, what are the different bases of measurement of element in the financial statement? See, there are 4 bases of measurement. It's called historical cost, current cost, realizable value, present value. Let's take an example. Let's say 3 years ago, I bought a machine for 10 lakh. So I bought it for 10 lakhs. So 3 years back, that 10 lakhs is called what? Historical cost. So can I say whatever is paid already is historical cost. Same machine, if I have to buy right now in the market, it's available at 11 lakh. I got it for how much? 10 lakh. If I want to buy the same machine today, the price has gone up to 11 lakh. That 11 lakh is called current cost. So historical cost means what? Whatever is paid. Current cost means what you're supposed to pay if you want to buy same asset today. What is the realizable value? Now I bought the machine 3 years back. That machine, if I sell it in the market, let's say I'm expecting 9 lakh. This 9 lakh is called a realizable value. So current cost means what I'm supposed to pay. Realizable value is what I'm supposed to receive. If I sell it in the market, I'll get how much? 9 lakh. That is called realizable value. And what is the meaning of present value? I'm sure all of you have learned this in other accounting standard. Present value is nothing but you have to find out the future economic benefit, multiply that future economic benefit with a present value index factor that will give me present value of the asset. So as per accounting standard 1, there are 4 different bases of measurement: historical cost, current cost, realizable value, and present value. Okay. So this is a brief summary of accounting standard 1. Okay. Now, without wasting much time, let's move on to accounting standard 2, which deals with the valuation of inventory. Okay. Now, what is the meaning of inventory? Can I say inventory can be raw material, work in progress, finished goods, any consumables, stores and spares. All these put together, we call it as inventory. Now, this particular accounting standard 2 is not applicable in case of Financial instruments. So when I say financial instruments, it can be like shares, debentures, all that. Because for shares and debentures, we are covered under accounting standard 30. And because there is a separate accounting standard for that, they are not covered under accounting standard 2. Same way, it is not applicable to construction contract because they are covered under AS7. AS2 does not deal with service providers. And similarly, AS2 does not deal with livestock, agricultural produce, mineral oils, all that. Okay, not that important. Just remember for MCQ questions if they can ask you. The most important topic of accounting standard 2, very, very important. What is the inventory valuation principle? So our main focus will be on this topic. Inventory will be valued at either cost price or net realizable value, whichever is lower. Now you need to understand what is the meaning of cost price, what is the meaning of net realizable value. See, when I say cost price, this is the combination of cost of purchase of the raw material, cost of conversion, or any other expenses incurred to bring the inventory to present location and present condition. You have to remember that anything incurred to bring the inventory to present location and present condition. Now try to understand what is the meaning of cost of purchase. What is the meaning of cost of purchase? See, cost of purchase in simple words is nothing but your material cost, nothing but direct material cost. Now, how do you get cost of purchase? Any purchase price that you're paying, any non-refundable tax, very important, only non-refundable tax should be added. Any freight and carriage you are paying to bring the inventory, any loading and unloading expenses, toll fees, etc., etc. And from there, you should remove trade discount and refundable taxes. And when I do all that, what do I get is a material cost. I'll simply say direct material. Now, this material I should convert into finished item. To convert the material into finished item, I'll be incurring something called cost of conversion. That is nothing but the total of direct labor and production overhead. So, in simple words, can I say the cost of the inventory is nothing but direct material, direct labor, production overhead. All the three put together is called as cost price of the inventory. Cost price of the inventory. And when I say production overhead, this production overhead can be subclassified into variable production overhead, fixed production overhead. Very, very important. You have to focus carefully. So this production overhead can be variable or fixed. And when I say variable, what is the meaning of variable? So if you increase the production, expense also goes up. If you reduce the production, expense also come down. It's just if there is a variable production overhead, this will be absorbed on the basis of actual production. Very, very important point. So if there is a variable production overhead, you will do the absorption on the basis of actual production. Let's take an example. Let's say we have a variable production overhead 12 lakhs. Normal capacity of the factory 4 lakh units. What is the meaning of normal capacity? If I use my factory to 100% optimum capacity, normal capacity how much? 4 lakh units. But let us say during the year, my actual production is only 3 lakh units. Now, when I'm finding the cost of the item, cost of one particular unit, this variable production overhead, I should absorb on the basis of what? Actual production. So 12 lakh divided by actual production. So 12 lakh divided by 3 lakh, the cost of every one unit is going to be 4 rupees. So I should not worry about the normal capacity. I should look at only the actual production. So simply what I'll do, I'll take the variable production overhead divided by actual production. So what is the cost to be absorbed? 3 rupees I'll absorb in one unit. I hope all of you are clear. So this is what I'll do in case of variable production overhead. So what if it is fixed production overhead? If it is fixed production overhead, best example for that, can I say factory rent, factory manager's salary, all that. So in case of factory rent, whether you increase the production or whether you reduce the production, your rent is going to be same. So let's say you are paying a factory rent of 24 lakh. So irrespective of my production, my rent is going to be 24 lakh. So let us say Normal capacity of my factory is 12 lakh units. If I manufacture 100% capacity is 12 lakh units. But during the year, my actual production is only 8 lakh units. So let us say, irrespective of my actual production, my rent is going to be 24 lakhs only. So normally I should manufacture 12 lakh, but I actually produce only 8 lakh. So can I say there is some kind of inefficiency? I'm not able to manufacture based on my normal capacity. Actual production is only 8 lakh. So there is some kind of inefficiency. So now when I'm including rent in the cost of the FG, in the cost of the item, how much should I take? How much is the cost of one unit? How much rent I should add in the cost? 24 lakh. Should I take 12 lakh units or should I take 8 lakh units? So this particular accounting standard say you should observe a fixed overhead based on normal capacity or actual production, whichever is higher. And based on that, I'll take what? 24 lakh divided by 12 lakh, which means how much cost I'll include in the cost of one unit? 2 rupees will be included in the cost of every unit that you manufacture. I hope all of you are clear. So the reason being, so instead of 12 lakh, if I take 8 lakh, then I'll be absorbing only 3 rupees per unit. If you absorb 3 rupees per unit, indirectly my inefficiency, I'm including the cost of FG. And by including in the cost, tomorrow I'll be shifting the burden to the customer, which is not correct. So whenever there is your inefficiency, the burden cannot be put on the customer. And that is the reason I'll take normal capacity or actual production, whichever is higher. I hope all of you are getting that. Let's say in our example, okay, this point I want you to keep it in mind. So if it is variable on the basis of actual, if it is fixed production overhead, then you will absorb on the basis of actual production or normal capacity, whichever is higher. You should take whichever is higher. Very, very important. Please don't take whichever is lower. You should take whichever is higher. Okay. So this is how you find out cost. Okay, quick summary of what we have done. So cost is nothing but direct material, direct labor, production overhead. This production overhead can be variable or fixed. If it is variable, we will absorb on the basis of actual production. If it is fixed, you'll absorb on the basis of actual production or normal capacity, whichever is higher. I hope all of you are clear with the discussion about cost. Okay. This cost of the inventory will be compared with net realizable value. What is NRV? What is net realizable value? So if you look at the name itself, you should be able to figure it out. It is net realizable value. When I say realizable, can I say it's an expected amount, estimated selling price? Now, how do you get net realizable value? This is nothing but estimated selling price of the finished good. From there, I should minus estimated expenses to sell the item. Let's say I have the finished good in my godown. This item is expected to be sold in the market at 7 lakh. And in order to sell that for 7 lakh, I have to incur some expenses now. There can be salesman commission, there can be brokerage, there can be all that expense. And let's say that is 25,000 rupees. So estimated selling price minus estimated expenses, you do that. And what is the NRV you get? 6 lakh 25,000. So this is how you find out NRV of the finished good. So in simple words, I'll say ESP minus ESE, estimated selling price minus estimated selling expenses. Sir, what if it is work in progress? Okay, this is going to be one very important discussion. I want you to focus carefully. I want you guys to focus carefully. Yeah, let's move on to the next question. Mr. Rolex produces product X using raw material A. So can I say finished good is X, raw material is A. The following items are shown in this godown on 31st March 2020. You have 600 units of raw material, 500 units of partly finished goods, 1500 units of finished good X. Determine the value of closing stock. See, whenever everything is there in the question, I would recommend you first you calculate FG, then the work in progress, then the raw material. First, have a look at the last one. You have 1500 units of finished good. What is the cost incurred? 320. Whereas the expected selling price is only 300. So can I say NRV is lower? So since NRV is lower, I'll value the raw FG at finished goods at 300. So can I say 300 will be the value into how many units are there? 1500. So multiply that. Can I say that will give you 4.5 lakhs? Okay. Next one. 500 units of partly finished goods. We have partly finished goods, nothing but work in progress. What is the cost incurred till date? 260. This 260 rupee cost I have to compare with NRV. So how do you find out NRV of a work in progress? Estimated selling price of the finished good, we know 300. From that 300, it should minus estimated cost of completion. That is nothing but the difference between cost of WIP and cost of FG. What is the cost of WIP? 260. What is the cost of FG? 320. So what is the estimated cost of completion of the product? 60. So remove that 60. So that will give you NRV 240. Now you compare 260 and 240, whichever is lower. Which is now can I say I'll be valuing the WIP at 240. So 500 units multiply with 240. So 500 into 240 and that should give you 1.2 lakhs. So we got FG 4.5 lakhs, a work in progress, so 1.2 lakhs. Next, 600 units of raw material. And for raw material valuation, you have to compare what? Cost of FG and NRV of FG. In our example, what is the NRV? 300. What is the cost? 320. Your NRV of finished good is less than cost of the finished good. And if NRV is less than the cost, then raw material will be valued at cost or replacement price, whichever is lower. Now, what is the cost of the raw material? 120. What is the replacement price? 90. So I'll value raw material at what value? 90 into how many units? 600. So 90 into 600, that will give you 54,000. So can we finally conclude raw materials value 54,000, work in progress 1,20,000, finished good 4.5 lakh, add everything and that is going to give you 6,24,000. That is going to be value of your closing stock. I hope all of you are getting that. Yeah. We'll move on to the next example. Calculate the value of raw material and the closing stock based on the following information. Here also we have raw material also is there. FG is also there. Okay. Now first raw material X is there. 500 units we have. Cost price including excise duty. Okay, 200 including the excise duty. And for excise duty, SENVAT credit is available. So can I say refundable tax? So if it is refundable tax, you'll remove that. So can I say 200 minus 10, I'll take 190. Freight inward, I should add 20. Unloading charges, I will add 10. So can I say 190 plus 20 plus 10? So what is the cost of the raw material? 220. And what is the replacement price? 150. So you bought it for 220. Same material now available at 150. Okay. Then you have finished goods. Why? How many units are there? 1,200. We have, how do you find out the finished goods cost? Direct material 220. That is nothing but this 220. Material 220. You have labor 60. Direct expenses 40. And apart from that, you have a fixed overhead of 2 lakh. Normal capacity is 20,000. And whenever there is a fixed production overhead, how will you absorb that? You will take normal capacity or actual production, whichever is higher. And there is no information about actual production. So I'll take normal capacity only. So can I say 2 lakh divided by 20,000? So how much should I include here? 10 rupees I will add. Fixed production overhead also will be added in the cost. So can we say finally 220 plus 60 plus 40 plus 10. So that is going to give me 330. So the total cost of the finished good is going to be 330 rupees. Okay. Now calculate the value of closing stock. What is case 1? NRV of FG is 400. Now tell me, NRV is 400. Cost is 330. So whichever is lower. So I'll take 330 for FG into how many units are there? 1,200. So this will be a finished good value. 330 into 1,200 plus in this example, NRV of 330. Sorry, NRV is 400. NRV is 400. You compare with cost. So NRV is more than the cost. If NRV of FG is more than the cost, then raw material will be valued at cost only. So raw material cost, how much? We know the cost already. 220 is the raw material cost into how many units of raw material we have? 500. That's all. Simplify this. So FG will be 330 into 1200. Raw material will be 220 into 500. If you add all this, that is going to give you closing stock value. Hope all of you are getting that. Sir, what if NRV of the FG is 300? NRV of the FG is 300. Now just verify this. We know the cost of FG 330. NRV how much? 300. So whichever is lower. So now FG will be taken at 300. 300 into how many units are there? 1200. This will be my FG. Plus, if NRV is 300, it is less than the cost now. And if NRV is less than cost, raw material will be valued at. Raw material will be valued at cost or replacement, whichever is lower. And we already know what is the cost of the raw material, 220, and what is the replacement price, 150. So I should take whichever is lower, which is I'll take the raw material value to be 150 into how many units? 500. So simplify this, and that should give you the total value of closing stock. I hope all of you are understanding this particular discussion. Okay, done. So let's move on to the next question. Calculate per kg value of finished good. They're asking you what? A per kg value of finished good consisting of, first they have given direct material cost 200. Then you have direct labor cost 40. Then you have direct variable expense. Direct variable expense is there 20. I should add all that. Then you have fixed production overhead of 30 lakhs. Normal capacity is 2 lakh units. Calculate a per kg value of FG, case 1, case 2, case 3. So let us take up one by one. So first let us take up case 1. In case 1, what is my normal capacity? 2 lakh. What is my actual production? 2 lakh. Both are same. So you take whatever you want. So actual also 2 lakh and normal also 2 lakh. So I will absorb the fixed production overhead. Fixed production overhead. 30 lakhs is the total divided by 2 lakhs. So how much should I add in the cost? 15 rupees. So simplify all this. Can I say the total cost per kilo is going to be 275? 275. This is for case number 1. Let's move on to case 2. Case 2. Can we say direct material, direct labor, direct expense, all that is going to be same. So it will be 200, 40, 20. Now in case 2, what is your normal capacity? 2 lakh. What is your actual production? 3 lakh. And whenever there is a fixed overhead, you should absorb based on whichever is higher. So normal is 2, actual is 3. So I should take what? 3 lakh. So when I'm adding the fixed production overhead, it's going to be 30 lakh rupees divided by 3 lakh units. So how much will you include in the cost per 1 kilo? 10 rupees. So now can I say the cost per kilo is going to be 270 rupees? So the fixed production overhead, I should take either actual or normal, whichever is higher in the denominator. I hope all of you are getting that. Okay, this is case number 2. Case 3. So in case 3, they are given you 1.5 lakh units. Can I say the remaining discussion is same? Direct materials 200, direct labor 40, direct expenses 20. And now they say actual production is only 1.5, whereas normal capacity is 2 lakhs. So I should take what? 2 lakhs only. So now it will be 30 lakhs is the fixed production divided by 2 lakhs. So how much should I add in the cost? 15 rupees, which is your total cost per kilo is going to be 275, which is same as case number 1. Okay. And apart from that, there is one simple theory question. You can just go through that. What are the different exclusions from cost? So when you are finding out cost of inventory, these 5 items should never be included. Just go through that. Abnormal losses, office expense, storage cost, selling and distribution, and finance cost. These items should not be added in the cost of the inventory. Okay. So with this, we have done a quick summary of accounting standard 2. Okay. I hope all of you are clear. Okay. See, this is a very important example that you need to understand to get the concept clarity. We know that inventory should be valued at cost or NRV, whichever is lower. How do you get NRV of a finished good? Estimated selling price. From there, you remove estimated selling expense. Let's take an example. Example number one, we are dealing with finished good. Let's say direct material is 50, direct labor 40, and let's say we have some direct expenses and production overheads all put together, let's say 50 rupees. So can I say the total cost of the finished good is going to be 140 rupees? This is the cost of the finished good, correct? This cost of the finished good I should compare with net realizable value. So NRV is how much? 160 minus 16. Your NRV is going to be 144. Now I am supposed to value at cost or NRV, whichever is lower. So can I say in our example, your value the inventory at 140 because that is lower than NRV. This is how I value FG. Now, same example, let's say work in progress. Sir, if it is work in progress, then how do you value? See, if it is work in progress, can I say the cost of the work in progress will be less than the cost of the finished good? Now, in our example, what is the material cost here of 50? But in case of work in progress, the material will be little lesser. So I have taken 40. Direct labor in the place of 40, I have taken 30. Direct expenses, sorry, direct labor is 30. Direct expenses and production overhead put together instead of 50, I have taken 40. Now, what is the total cost of work in progress you're going to get? Total that will give you the cost of the work in progress. Can I say 70, 110 rupee? Now, 110 is the cost of work in progress. Now, how do you value that work in progress? I know the cost. How do you find out NRV? How do you find out NRV? Because work in progress is semi-finished item. If it is a semi-finished item, there is no ready market available. If there's no ready market available, how do you find out the estimated selling price? Now what I'll do, I will take the estimated selling price of the finished good itself, which is going to be 160. Take that. From that 160, you will minus something called estimated cost of completion. And what is the meaning of this estimated cost? Can I say? We know the cost of work in progress is 110. Cost of FG is 140. So to convert the work in progress into the finished item, how much more extra amount I have to spend? 30 rupees. And this 30 rupees is nothing but the estimated cost of completing the item from the work in progress to the finished good. So take that figure also, remove that. In addition to that, you should also minus estimated selling expenses. In our example, it is 10% of selling price, which is 16. So it's going to be 140. So cost is 110, NRV is 114. So I'll value at whichever is lower. I'll take how much? 110. So the point to be kept in mind, when you are finding out NRV of the work in progress, what is the formula? Estimated selling price of the finished item. From there, it should also minus estimated cost of completion and also minus estimated selling expenses. Okay. Now, the next important point, very, very important, guys. I want you guys to focus carefully. How do you value the raw material? Now, for valuation of raw material, you need to compare NRV of the finished good with the cost of the finished good. If NRV of the finished good is greater than or equal to cost of the finished good, then I'll value the raw material at cost. Okay. If NRV of the finished good is less than the cost of the finished good, then we'll value the raw material at cost or replacement price, whichever is lower. What is the meaning of that? Let us try to understand by taking one example. Let's take an example. Let's say example number one. Let's say NRV of finished good 100. Cost of the finished good 80. Cost of the raw material 25. Replacement price of the raw material 20. What is the meaning of replacement price? See, replacement price is nothing but same raw material. If I buy now in the market, how much I'm supposed to pay? Okay. Now, if you look at our example, example number one, if you see, FG will be valued at. So finished good will be valued at cost or NRV, whichever is lower. So cost is 100, sorry, cost is 80, NRV is 100. So I'll value the FG at what value? 80. So finished good will be valued at 80. And what is the value of raw material now? For that, what you should do? Compare NRV of FG with cost of FG. In our example, your NRV is more than cost. And if the NRV of the FG is more than the cost of the FG, raw material will be valued at cost. So what is the raw material cost? 25. So in our example, FG will be valued at 80 and RM will be valued at 25. I hope all of you are understanding. Which is for raw material valuation, you need to look at FG. Okay, let's take an example 2. One more example to understand it better. Let's say NRV of FG is 80, cost also 80, and cost of the raw material 25, replacement price of the raw material 20. Now first you look at FG, cost and NRV both are same, so I'll value at 80. 80, you take whatever you want. Now raw material valuation, for raw material valuation, what does the standard say? If NRV of the FG is equal to cost of the FG, then raw material will be valued at cost. So in the example number 2, NRV and cost are equal. And if NRV and cost are equal, raw material will be valued at cost. So I'll value the material at 25. So FG will be valued at 80 and raw material will be valued at 25. And last example, let's say example number 3. NRV of the finished good is 70. Cost of the finished good is 80. Cost of the raw material is 25. Replacement price of the raw material is 20. Now first look at FG, cost or NRV, whichever is lower, whichever is lower. So can I say FG will be valued at 70? FG will be valued at 70. Now for raw material valuation, look at the flowchart. If NRV of the FG is lower than cost of the FG, in our example, how much is the NRV? 70, which is lower than the cost. If it is lower than the cost of FG, then raw material will be valued at cost of the material or replacement price, whichever is lower. So what is the cost of the material here? 25. Replacement price is 20. So I'll value the material at 20, whichever is lower. So I'll value the material at 20. I hope all of you are clear. So in the first two example, I'll value the material at 25. But in the last example, I'll value the material at 20. So this entire flowchart is very, very important. I hope all of you understood. Okay. So this is how you value FG, work in progress, and raw material. Clear? Okay. The next important topic in inventory valuation, treatment of a normal loss and abnormal loss. A very, very important point. I want you to understand this carefully. Now, what is the meaning of normal loss? See, normal loss is nothing but any loss which happens because of the nature of the product. See, best example, let's say I'm dealing in vegetables or fruits. What is the normal loss I'm going to pay? Can I say perishability is a normal loss? Similarly, let's say I'm a petrol dealer. If I'm a petrol dealer, what is the normal loss? Can I say there is an evaporation? So all this is happening because of product nature. There's no mistake from my side. It's only because of the product nature. So whenever there is a normal loss, we will minus that only from the quantity. You'll minus that only from the quantity. You will not minus from the value. Very important. So if there is a normal loss, your quantity will reduce, but the value of the item will remain same. Because of that, when I find out per unit cost will increase. Which is when there is a normal loss, will increase the cost of 1 unit. Cost per unit will go up. Okay. But what if there is an abnormal loss? See, abnormal loss is anything other than normal loss. Okay, it's not because of the nature of the product. If there is an abnormal loss, you will minus that from both the quantity also, value also. So you are not going to increase the cost per unit here. So what are you trying to say? I'll give an example. I'll try to explain with the help of an example. Look at an example. Okay. So in our example, we purchase 1,000 units at 28. Can I say quantity is 1,000, 28 rupees rate, 28,000 is the amount. Okay. And there is a freight inward. So anything you pay to bring the item till your present location, I should add. So I'll add the freight, 500 rupees I'll add. So can I say 1000 units? Your cost will become 28,500. Correct? About 1000 units, cost will become 28,500. Now there is a normal loss in the transaction. And when there is a normal loss, you should minus only from where? Quantity. So I'll minus normal loss here. Normal loss 5%. So can I say 50 units? From the value, I will not minus. Because of that, can I say the quantity will become 950, whereas the value will continue to be 28,500. Correct? So because of that, if I find out the cost of one unit now, the revised cost will increase. Can I say 28,500 divided by 950? So what is the cost of one unit is going to be 30 rupees. Which is whenever there is a normal loss, I'm going to increase the cost of the remaining units. So because the quantity reduces, value remains same. So what will happen to the cost per unit? It goes up. So the cost is going to be 30. Okay. Next is a company received only 920 units. Sir, we are supposed to receive how many units? 950, but we received only 920 units. So can I say there is over and above normal loss, abnormal loss also? Abnormal loss. So how much is abnormal loss? Can I say 950 minus 920? There's an abnormal loss of 30 units. And when there is abnormal loss, you should minus from quantity also. You should minus from value also. So what is the value of the abnormal loss now? 30 units are there. And cost is 30 rupees per one unit. So 30 into 30, it's going to be 900. So remove that. So 950 minus 30, 920 units. And the cost of one unit will be 30 rupees. So it's going to be 27,600. So the point you should keep in mind, if there is a normal loss, only quantity you will minus. If there's an abnormal loss, you'll minus from quantity also and you'll minus from value also. Okay, I hope all of you are getting this point. Okay. So finally, 920 units, cost is 30, 27,600. And out of the 920 units, how many units are sold off? 900 is sold out. So I'll remove that also, sold 900. And what is the cost of the goods sold? 30. So 900 into 30. So how much is the cost of the goods sold? 27,000 is called the cost of the goods sold. So tell me how much will be your closing stock? So can I say your closing stock will be 20 units are left. And what is the cost of one unit? 30. So 20 into 30, 600 will be my closing stock. I hope all of you are understanding the treatment. Now look at what are they asking? Find out the closing stock. How much is the closing stock? 600. Find out abnormal loss. How much is the abnormal loss? 900. Find out a gross profit and net profit. Okay, let's discuss these two also. Gross profit. Can I say gross profit is nothing but a sales minus cost of the goods sold? We know the sales. How many units are you selling? 900 units are you selling. And what is the selling price? 40 rupees. So can I say sales will be 900 units into 40 rupees. So my sales will be 36,000. And from the 36,000, what is the cost of the goods sold? We found out now. What is the cost of the goods sold? 27,000. So from 36,000, if I remove 27,000 cost, my gross profit is going to be 9,000. I hope all of you are getting that. So that is one way of understanding. Another way of understanding, if you see, can I say cost of one unit is 30? Cost of one unit is 30 and you are selling it for 40. So 30 rupee, you are selling at 40 rupees. So can I say 10 rupee profit? 30 rupees, if you are selling at 40, there is a 10 rupee profit. So 10 rupees profit, and how many units you are selling? 900 units. So 900 units into 10 rupees. So what is your profit going to be? 9,000. Different ways of understanding. I hope you're getting that. Okay. Now, apart from gross profit, what is being asked in the question? Also find out net profit. Very simple. So can I say net profit is nothing but gross profit? From there, I'll remove abnormal loss. So we know gross profit is 9,000. From there, what is the abnormal loss? 900. So which means your net profit is going to be 8,100. Okay, I hope all of you are getting this entire discussion. Now, so if you look at these differences, I gave one point. Normal loss will affect your gross profit. Exactly. See, in our example, because of the normal loss, cost per unit has gone up now. Correct. Cost per unit has gone up here. The cost has become 30. And because your cost has gone up, per unit cost has gone up, can I say profit per unit comes down? When the cost per unit goes up, profit per unit comes down. Which is indirectly, normal loss will have an impact on which profit? Gross profit. Normal loss will have an impact on gross profit. Whereas abnormal loss will be taken in profit and loss account. So this will have an impact on net profit. Okay, I hope all of you understood this. This is a very, very important concept. I hope all of you are clear. Okay. Now let us try to do some questions on accounting standard 2. Okay, let's have a look at this question. Question number 1. Legend Pharmacy ordered 16,000 kgs of material costing 160 each. The purchase price of the material includes 10 rupee GST, and for the 10 rupee input tax credit can be taken. So can I say there's a refundable tax? If it is a refundable tax, I should not take that in the cost. So can I say from 160 rupees, I'll remove the 10 rupees. So your cost is going to be 150. Okay. Freight is there. I should add in the cost 140, 160. And there is a normal transit loss of 2%. So it's a normal loss. You should minus only from quantity. Okay. And we are actually receiving only 15,500 kgs of material. And out of that, we consumed 13,600. Find out closing stock and abnormal loss. I want you guys to try this question on your own and verify. Okay, I'll explain that quickly. 16,000 kilos are there. And what is the cost? 150. Because the 10 rupee tax has to be removed. 150. So 16,000 into 150, can I say 24 lakhs is the cost? To that, I should add freight. Freight is given to us. How much is the freight? 1 lakh or 40,160. I'll add. So can I say 16,000 kilos, 25 lakh or 40,160? Correct? Now there is a normal transit loss. And when there is a normal transit loss, you should minus only from where? Quantity. So I'll remove normal loss 2%. Can I say 320? Quantity will be removed. Value will remain same. So can I say 15,680? But the value will remain 25 lakh or 40,160. Now you find out the revised cost per unit. Can I say this divided by this will give you 162 rupees? I hope all of you are understanding. So 25, 40, 160 divided by 15,680. So what is the cost per 1 unit? 162. Now I'm supposed to receive 15,680. But look at the question. How many units are actually received? There is only 15,500. So instead of 15,680, you are receiving only 15,500. So can we say there is an abnormal loss also? Abnormal loss is there. So how much is the abnormal loss? 180 units. This abnormal loss, 180 units into 162, do the calculation, remove that. And that is going to give me 15,500 units. Cost will be 162, multiply that, that will give you the total value. And out of that 15,500, it's given in the question, how many are consumed? How many are consumed? 13,600 is consumed. Remove whatever is consumed. So remove whatever is consumed, 13,600. Cost will be 162. Multiply that, that will give you cost of the material consumed. Now tell me what is the final closing stock? So can I say closing stock will be 1900 units into 162, multiply both, and that is going to give me closing stock. I hope all of you are understanding. So this is how you treat normal loss, abnormal losses as per accounting standard 2. Yeah, now let us move on to accounting standard 10. This particular standard deals with the property, plant and equipment. Now, what is the meaning of property, plant and equipment? Any kind of tangible asset. And normally this we hold in the business for the purpose of either production of goods, rendering of services, earning rental income or administrative purpose. And normally these kind of assets are not meant for resale. Okay. And this particular accounting standard 10 is not applicable to biological asset. So when I say biological assets can be like livestock, cattle, etc. For that biological asset, AS10 is not applicable. So there is an exception here, which is bearer plant. So which indirectly means AS10 is applicable for bearer plants. Okay, keep that in mind. It can be tested in MCQ questions. And apart from that, AS10 is not applicable to wasting assets. And when I say wasting assets, it can be something like mines, ores, etc. For all that, AS10 is not applicable. Okay. In this entire accounting standard 10, this is a very, very important discussion that's going to happen. Carrying value of the asset. See, accounting standard 10 gives you two different options. What is the meaning of carrying value? So carrying value is nothing but amount to be shown in the balance sheet. So when you are showing a PPE in the balance sheet, you've got two different options. One is called a cost model. The other one is called a revaluation model. So how many options are there? Two options. Cost model, revaluation model. Now, if you are following cost model, then the asset will be shown at whatever is the cost of the asset. From there, you'll minus accumulated depreciation as per AS 10, and also you will minus impairment loss as per AS 28. Just keep that in mind. So when you follow cost model, asset will be shown at whatever is your cost minus depreciation, also minus impairment loss. This is called cost model. The other one is called a revaluation model. So either you can follow cost model or revaluation model. So when you follow cost model, you have to find out the cost of the asset. Now that cost of the asset depends upon the mode of acquisition. So the historical cost depends upon various circumstances. Now, there are different ways how you get the asset. So what is the first one? Purchase. So if you are buying a fixed asset, if you are buying a PPE, how do you find out the historical cost of that? Whatever is the price you are paying, any duties and taxes which are non-refundable, any freight and carriage that you are paying, any site preparation charges. What is the meaning of site preparation? So let's say I want to install a machine. If I want to install a machine, I need to keep the place ready for that. So let's say I'm keeping the place ready for that. I'm doing some dismantling, etc., etc. To keep the place ready, I'm spending 5,000 rupees. That is called site preparation charges. And once the place is ready, I need to install the machine now. For that, I'll be hiring some technician. I'll be paying some installation expenses. And that also I should add in the cost. Any engineer fees that you are paying for supervision of the entire installation. And apart from that, the most important point, the present value of the decommissioning charges. Let's say I bought a machine today. The life of that machine is 5 years. At the end of 5 years, that machine has to be dismantled, right? So you need to expect how much will be the dismantling at the end of 5 years. So let's say at the end of 5 years, 10,000 is expected dismantling charges. That 10,000 should be converted into today's value. I should find the present value of that and add to the cost. Clear? So this is a very, very important point as per accounting standard 10 revised. Is that clear? So in simple words, whatever you spend to bring the asset to present location and present condition, that should be added to find out the historical cost in case of a purchased asset. I hope all of you are clear. This is how you find out purchased asset. Sir, what if it is self-generated asset? See, when I say self-generated asset, what does it mean? Are you buying it? Are you constructing it? You're constructing. And if you're constructing an asset, let's say I'm constructing a building. Sir, if I'm constructing a building, how do you find out the cost? Can I say whatever material I'm incurring, all the labor charges, all the direct expenses, all production related overheads? So in simple words, how do you find out the cost of self-generated asset? Direct material plus direct labor plus direct expenses plus production overhead. These four will give you the cost of self-generated fixed asset. A very important point here, when you are finding the cost of that, you should exclude internal profit or unrealized profit. What is the meaning of this internal or unrealized? Let me give an example. Let's say there is one company. This company has got two different departments. Let's say we have a civil department and a finance department. So civil department, what is their major activity? They are into construction. And finance department is into all finance related activities like accounting, GST reconciliation, whatever it is. Now, this finance department, they wanted a building. If they want a building, will they go to some outside person or will they approach civil department? They'll approach civil department. Now let us say civil department is constructing the building. So the total cost of the building is 40 lakh. Who is incurring all that cost? Civil department. And once they incur all that cost, once the building is ready, that building is transferred by civil department to the finance department. And when they are doing that, what the civil department will normally do? On that cost, they add something like profit. Let's say 5 lakh rupee profit they're adding. So when they're doing the billing, they'll do the billing for how much? 45 lakh. So what is the billing amount? 45 lakh. Correct? So civil department is selling the bill into finance department by adding a 5 lakh rupee profit. So I'll be billing for how much? 45 lakh. Now, when I prepare the balance sheet of the company as a whole, from the company point of view, can I say civil department and finance department are like two pockets of the same person? So now in company balance sheet, when I show the building, should I show 40 lakh or 45 lakh? So it should be 40 lakhs only, because this 5 lakh rupees is the profit, is an internal profit. Sir, you are not selling to any outsider. One department is selling to another department, which means that 5 lakh rupee profit is not realized now. When do you realize the profit? Only when you sell to some outsider. You cannot book the profit by selling to your own self, which is in my balance sheet. I'll not show the building at 45 lakh. I'll show the building at 40 lakh. So the point to be kept in mind, in case of self-generated asset, internal profit has to be eliminated or excluded. Okay. So we are trying to understand the concept of historical cost in different cases. So first we understood purchased. Second one is self-generated. Next one. Sir, what if you are exchanging an asset? Can I say it's like a barter? So when you are exchanging the asset, the new asset, whatever you are buying, the new asset has to be recorded at the fair market value of the asset given up. Say, let's say I'm buying a building and I'm giving up furniture. So the building has to be recorded at the fair market value of the furniture. Just when I'm debiting the building account, I should not take the market value of building. I should take the market value of the asset that is given up. So if you don't know the market value, if it is not clearly evident, then the new asset will be recorded at fair market value of the asset acquired. So the first preference will be given to the fair market value of asset given up. If you don't know that, then you'll record that fair market value of the asset acquired. If you don't know both the fair market values, then the new asset will be recorded at book value of the asset given up. I hope all of you are understanding this. I'll take an example to make you understand this concept. Let's say in our balance sheet, I have furniture. The book value of the furniture is 8 lakh. And what are we doing? This furniture I'm giving on exchange. And in the place of furniture, I'm receiving machinery. So can I say furniture is going out, machinery is coming in. Now when machinery is coming in, which account should I debit? I should debit machinery account. So this machinery account will be recorded at which value? So this machinery will be recorded at fair market value of the asset given up. What are we giving up? Furniture. So let's say the market value of the furniture is 7.5 lakh. Now the machinery will be recorded at which value? 7.5 lakh. So the new asset will be recorded at 7.5. So if I don't know the fair market value of furniture, if I don't know, then I will record the machinery at fair market value of the machinery itself. If I don't know the fair market value of the machine also, then I will record the machinery at fair market value, at the book value of the asset given up. What is the book value of furniture? 8 lakh. So the quick summary, the new asset will be recorded at first preference should be given to the market value of asset given up. If you don't know, market value of asset acquired. If that is also not given, book value of the asset given up. Okay, this is how you find out the cost in case of exchange. Finally, if you are receiving the asset at free of cost, this is accounting standard 12 point. I'm sure all of you remember that. So if you are recording, if you're receiving any asset at free of cost from the government, you will show it at nominal value. Is that clear, guys? So with that, we complete option number one. What is that? Cost model. So when you follow cost model, asset will be shown at cost minus depreciation minus impairment loss. So we understood the meaning of cost in four different scenarios. What are the four scenarios? Purchased, self-generated, exchange, and free of cost. Now let us move on to option two. What is option two is called? Option two is called a revaluation model. Okay, very important this one, revaluation model. Now let's take an example. Let's say we have a building book value 10 lakh. This building is revalued at 12 lakhs. So building is going up. So if the building is going up, so what is the journal entry? Can I say building account I will debit 2 lakh. Building account debit 2 lakh. And this 2 lakhs will go to an account called revaluation reserve account. So the entry will be building account debit to revaluation reserve. Is that clear? Now the building became 10 lakh has become how much? 12 lakh. Same building, subsequently we revalued at 9.5 lakh. So can I say initially it became upward, subsequently we are doing downward. Now what I'll do, from 12 lakhs, if it becomes 9.5 lakh, how much is the reduction? Can I say there's a fall of 2.5 lakh? Now the entry is going to be revaluation reserve account debit. How much is the balance available there? 2 lakh. Remaining 50,000 will be debited to profit and loss account to building 2.5 lakh. So what is the point you should keep in mind? Whenever you are doing first time upward, you'll credit which account? Revaluation reserve. Subsequently, if you revalue downward, first you will utilize the revaluation reserve and balance will go to P&L. I hope all of you are clear with that. Okay. So what if you do first time downward, subsequently upward? Now look at the example. What is the book value of the building? 10 lakh. From 10 lakh, first time itself I am doing downward, 8 lakh. Now, first time itself, if I am doing downward revaluation, I don't have revaluation reserve with me. And since I don't have revaluation reserve with me, I'll book the entire amount in profit and loss account like a loss. So the entry is going to be profit and loss account debit to building 2 lakh. Is that clear? Next. From 8 lakhs, now it became how much? 10 lakh 20. Now subsequently we are increasing. So 8 became 10 20. So how much is the increase in the building value? 2 lakh 20,000. Now the entry is going to be building account debit 2 lakh 20. This loss has to be reversed. So can I say to profit and loss account 2 lakh? The remaining amount will be credited to revaluation reserve. Which means if you are doing the downward for the first time, it will debit to P&L. Subsequently, if you increase it, first what you should do? Reverse the P&L, then the balance will go to RR. I hope all of you are understanding this point. Is that clear? Okay. So this topic number 3 is the most important topic in accounting standard 10. I hope all of you are clear. So two models we have, cost model and revaluation model, and we can follow whichever accounting policy we want. Is that clear? Okay, moving on. Next topic, component accounting. So let's say you're manufacturing some big assets. Let's say you're building a ship or you're manufacturing an aircraft. So in these kind of assets, is a combination of multiple components. Let's say you're manufacturing aircraft. So what are the different parts of an aircraft? Can I say there'll be something called wings, there is something called fuselage, there is something called engine. So there are multiple components and each component has a different useful life. So you can say engine has a different life, wings has a different life, wheels has a different life. So if each component has a different life, what you should do? You have to depreciate also separately. And that is what is the meaning of component accounting. And where is component accounting is possible? Only when there are significant components and each component should have a different useful life. Then depreciation also will be calculated separately. This is what is component accounting. Next topic of the standard. If you are incurring any subsequent expenditure, how do you treat that? Sir, if you are incurring any subsequent expenditure, If that expenditure is improving the asset, if it's improving the future economic benefit, then what I will do? Capitalize. So what is the meaning of capitalizing? I'll add that in the asset cost. Let's say I'm running a movie theater and I improve the screen quality from 2K resolution to 4K, let's say. Now can I say this expenditure is improving the benefit, improving the benefit? So I'll be capitalizing that. What is the meaning of capitalizing? I'll include in the cost of the asset. But let's say you're incurring some repairs and maintenance cost. In that case, subsequent expenditure does not increase the efficiency. Then I'll transfer that to profit and loss account. Hope all of you are clear with that. Next topic, retirement of an asset. Now, what is the meaning of retirement? It means, sir, asset is there physically with you. Asset is there in our factory, but the asset is retired from active use. What does it mean? I'm not using the asset. Sir, even though it is lying with me, I'm not using it. Simply lying with me. These kind of assets, we call it as a retired asset. Retired asset. These assets shall be valued at book value or realizable value, whichever is lower. Very important point, can be tested in MCQs. Remember that. So the moment asset is retired, I'll value that at. Let's say the book value is 20,000, but the realizable value is only 5,000 in the market. So I'll show the asset at 20 or 5, whichever is lower. Which is in our example, the asset will be shown at 5,000. There is a difference of 15,000. That 15,000 is like loss, which will be transferred to profit and loss account. I hope all of you are clear with that. Next concept. If you are changing the life of the asset, or if you are changing the method of depreciation, let's say from SLM to WDV, whatever it is, any kind of that change, be it life of the asset or method of depreciation, both these changes are treated like, very important point, changes in accounting estimate. So this is not a change in policy, this is a change in estimate. As per accounting standard 5, remember that. And whenever there is a change in accounting estimate, you need to give something called a prospective effect. What is the meaning of prospective? From the year of change. Let's say year 1, 2, 3, I followed SLM method. In the fourth year, I'm changing it to WDV method. So if I'm changing it to WDV method in fourth year, should I recalculate everything from year 1 or should I do calculation only from fourth year onwards? So I should do the changes only from fourth year onwards, and that is what is called as a prospective effect, which is whenever there is a change in the estimate, it's always a prospective effect. Okay. Okay, so this is a quick summary of accounting standard 10. Now let us do some questions on accounting standard 10. Okay. X Limited has incurred these costs. How much cost to be capitalized? They're asking you, what is the cost of the asset? Now let's go through the question quickly. Cost of the plant, 25. Excuse me, cost of the plant, 25 lakh. Take that. Then you have initial delivery and handling cost. Something similar to transportation, add that. Cost of site preparation, you should add that. Consultant used for advice on acquisition of the plant. So this is directly attributable to acquisition, add that also. Interest charges paid to the supplier for deferred credit. Now, what is the meaning of deferred credit? Deferred credit means you're not paying immediately, you're paying on a later date. And because you're paying on a later date, you're paying some extra interest also. And that interest is nowhere related to bringing the asset to present location and condition. Which in that 2 lakh, will it be added to the cost or will not be added? Will not be. But if you remember accounting standard 16, if that interest is related to qualifying asset, then I'm going to capitalize that. But in this example, what am I going to do? Ignore that. Next, estimated dismantling cost to be incurred after 7 years. Present value is given already 3 lakhs. So should I add that? Yes. Okay. Next, some operating losses are given to you before commercial production. Sir, if there is an operating loss, can I say there is no future economic benefit? A loss will never give you future benefit now. And if there is no future economic benefit, you cannot call it as an asset only. Which is that 4 lakh rupee loss should be transferred to profit and loss account. That cannot be added to the cost. So this also I'm going to ignore. Just add all this. That is going to give me cost. So can I say 27, 33, 40, 43 lakhs. So what is the cost to be capitalized? 43 lakhs. Hope all of you are clear. Next, question number two. Question number two. Aman Limited contracted with a supplier to purchase a specific machinery to be installed in department A in 2 months time. Okay, we are buying a machine, so you have to install in department A in 2 months. Special foundations were required for the plant, which have to be prepared within this supply lead team. The cost of site preparation 47,290. Should I add that in the cost? Yes, right. So 47,290 I'm going to add in the cost. Okay. Next. These activities were supervised by a technician during the entire 2 month period. And what is the salary of the supervisor? 15,000 per month. And how many months here? 2 months. So can I say 15,000 into 2? How much supervisor salary should be added there? 30,000. So till now 47,290 is there. 30,000 supervisor salary. Okay, so supervised by whom? One technician. This particular technician, these services were given to department A by department B, which is that supervisor is coming from outside or other department or a department. And that other department build the services at 16,500 after adding 10% margin. See here, what is the supervisor salary? 15,000 per month. That supervisor is coming from other department. So what is the other department doing? 15,000, they're adding 10% profit. So, and they're billing the services at how much? 16,500. Now you tell me, can I say that 16,500 has 1,500 rupee profit? And that 1,500 rupee profit is internal profit now. So that is from other department. It's an internal profit. And if it is internal profit, should I consider that or ignore the internal profit? Ignore. Which means, should I take supervisor salary as 16,500 per month or just 15,000 per month? Just 15,000 per month. Which means this entire sentence, I'm going to just ignore that. Ignore that. Because I cannot value at 16,500. I should take how much? 15,000 per month. Are you getting that? So this 16,500 has an internal profit of 1,500. I should ignore that. Okay. Ignore that. Next, the machine is purchased at 52 lakh 78,000. Okay. And then you have sales tax of 4%. So I'll calculate that 4% sales tax. So can I say 2 lakh 11,120 tax. And you have 18,590 transportation charges. That also we should add. Then one architect was engaged at a fees of 10,000 to supervise the installation. This also you should add. Okay. Also, the payment under invoice was due in 3 months. However, company made payment in second month. The company operates on a bank overdraft of 11%. Say, are you making the payment immediately or after 2 months? After 2 months now. So for the 2 months, you have to pay the 11% interest on the bank overdraft. But that interest should not be included in the cost. Should not be included in the cost because it's only a finance cost. It's nowhere related to bringing the asset to present location. So this also I'm going to ignore. Now just add 47,290, 30,000, then the price of that, sales tax, transportation charges, architect fees. And that is going to give you cost of the asset in this example. Yeah, let's move on to question number 3. On 1st of April 10, a machine was bought for 4 lakh. The life of the machine is given to you 10 years. Residual values 10% of the original cost, that is 40,000. At the end of year 3, attachment was made to the main machine at a cost of 1.8 lakh to enhance the capacity. This attachment is having a life of 10 years and no residual value. During the same time, the original machine was revalued upward by 90,000. The remaining life is assessed at 9 years and residual value is reassessed at 0. Find the depreciation if attachment retains separate identity. Second question, if attachment becomes integral part of the machine. See, if the attachment is maintaining separate identity, then what I should do? Depreciation I should do separately for the main machine, separately for the attachment. Now first look at the main machine. What is the cost of the main asset? 4 lakh. Minus, when are you doing the attachment of at the end of third year? So from the 4 lakh, I'll remove 3 years depreciation. So what is the cost? 4 lakh is the cost. Salvage value 10%, 40,000. So can I say 3.6 lakh divided by 10-year life. So 36,000 is the depreciation into how many years over? 3 years. So remove a depreciation of 1,08,000. So can I say the main machine book value is going to be 2,92,000? 2,92,000 is the book value. Now this is given to you during the same time when you bought the attachment, the original machine was revalued upwards by 90,000. So 2,92,000 plus 90,000 upward revaluation you are doing. So can I say the book value is going to become 3,82,000? So after adding the upward revaluation, so the book value is going to be 3,82,000. Okay. Now, what is the remaining life of that 9 years? And what is the residual value is going to be nil. So this 3,82,000 divided by what is the remaining life? 9 years. So find out the depreciation. So 3,82,000 by 9 years. So can we say 42,444? This is the depreciation of which asset? Main asset. And because it's a separate identity, main asset I have done separately. Now let us look at the attachment. Now look at the cost of the attachment. What is the cost of the attachment? 1,80,000. And what is the life of the attachment? 10 years with the zero residual value. So can I simply say 1.8 lakh is the cost divided by 10 years. So that is for the attachment that we are doing. 1.8 lakh by 10 years. So what is the depreciation going to be? 18,000. Now tell me what is the total depreciation? 42,444 for main asset, 18,000 for attachment. Add both, the total depreciation is going to be 60,444. Which is if they are maintaining separate identity, depreciate main asset separately, depreciate attachment separately. Okay. Now have a look at the next part of the question. Just say attachment becomes integral part of the main machine. So if attachment is becoming part of the main machine, then I cannot depreciate separately. Then what I'll do, I'll add main machine, attachment, add both, I'll depreciate together only. So in that case, what I'll do, sir, I know what is the value of the main machine. What is the value of the main machine? 3,82,000. Na? So 3,82,000 is the main machine. And because the attachment is an integral part, here itself I'm going to add it. What is the cost of the attachment? 1,80,000. Now both main machine and the attachment put together, what is the value? 5,62,000. Now this 562, we will depreciate taking the life of the main asset only. And what is the life of the main asset? 9 years. So calculate the depreciation. So 5,62,000 divided by 9 years is going to be 62,444. And this is the answer for second part of the question. I hope all of you are understanding. So if it is separate identity, separately you depreciate. If it's an integral part of the main machine, add both main machine attachment, then depreciate over the life of the main machine itself. I hope all of you are getting that. Okay. Let's move on to the next question. Question number 4 is given to you. Okay. Ascertain the value at which the following items will be shown in the profit and loss account and the balance sheet. Okay. Let's start one by one. Goodwill is valued by independent valuer at 120. No consideration was paid. So can I say there is a self-generated goodwill? And if it is self-generated goodwill, cost cannot be measured reliably. And if the cost cannot be measured, it cannot appear in the balance sheet. So that way, can I say in balance sheet, how much will come? Zero. Balance sheet, nil. And the company has not yet recorded the same, which is correcting. So balance sheet, nothing will come. And in profit and loss account, again, nil. So if I had already recorded, then what I should do? I should remove from balance sheet and transfer to P&L. So since it is not yet recorded, balance sheet also nil, profit and loss account also it's going to be nil. I hope all of you are clear with this. Okay, let's move on to the second part of the question. The balance of equipment on 1st April 2013 is given to you 1,20,000. Okay. Out of this equipment, one equipment book value 20,000 is retired from the use, and the NRV of that particular asset is 2,000. So this we have discussed already. If the asset is retired from the active use, we will value at book value or NRV, whichever is lower. So book value is 20. So NRV 2000. So how much will come in the balance sheet? Can I say balance sheet we are going to show 2000. The difference between the 20,000 and 2,000, that 18,000 is like depreciation that will go to P&L. I hope all of you are clear. So 2,000 will go to balance sheet, 18,000 will go to P&L debit side. Okay. Apart from that, see from 1,20,000, if I eliminate the 20,000 worth of asset which is retired from active use, what is the remaining asset value? 1 lakh. Hello, 1,20,000, you remove 20. What is the remaining value? 1 lakh. And that 1 lakh should be depreciated at 15%. Which means in the profit and loss account, how much will come? 1 lakh la 15%. So how much is the depreciation amount? 15,000. And in the balance sheet, it will be 1 lakh minus 15,000. How much will come in the balance sheet? 85,000. Yes, I hope all of you are clear. So the second part I have divided into two. One is retired from the active use. The other one is remaining asset. So in case of retired from the active use, so 2,000 in balance sheet, 18,000 in P&L. In case of remaining asset, 85,000 in balance sheet, 15,000 in P&L. Is that clear? Okay. Let's move on to the third part of the question. Okay, have a look at the third part of the question. Book value of the plant and machinery on 1st of April 2013 is given to you 7,20,000. Okay, this is the starting value. On 1st August 13, an item of machine is purchased by giving 500 equity shares. Okay, exchange we are doing. So when you are exchanging, the new asset will be recorded at the fair market value of the asset given up now, which means this machinery will be recorded at market value of the share. What is the fair market value of the share? 120. And how many shares you are giving? 500. So 500 shares into 120. So what is the value of the machine? 60,000 rupees. So can I say 60,000 is the machine value. And when you bought the machine? 1st of August. Which means that 60,000 machine will be depreciated at 10% from August to March. So how many months depreciation? 10 months. Sorry, 8 months. So calculate that. So 60,000, 10%, 8 months. So can I say it's going to be 4,000 rupees? So depreciation 4,000 that will go to profit and loss account. Remaining 56,000 that will come in balance sheet. Guys, so I hope all of you are clear. 500 shares you are giving. 120 is the market value. Multiply both. So what is the asset value? 60k. In that 4,000 depreciation will go to P&L for 8 months. Remaining 56,000 will come in balance sheet. Okay. And apart from that, you have original machine now 7,20,000. Sir, original machine 7,20,000. And that 7,20,000 I should depreciate for the entire year. What is the depreciation? 10%. So 7,20,000 in that 10%. So 72,000 will come in profit and loss account. Remaining, how much will come in balance sheet? Can I say 6,48,000 will come in balance sheet? I hope all of you are understanding. Okay. Okay, let's move on to the next question. Next question is given to you. ABC Limited has entered into a binding agreement with XYZ Limited, and they are buying a custom made machine amounting to 4 lakh. On 31st March 16, before delivery of the machine, the company has decided to change the method of production. The new machine will not be required because of that. And what is the scrap value given? 0. What is the treatment? Now, sir, you are buying a machine. What is the cost of the machine? 4 lakh. Now, because of the change in the production method, I cannot use the machine. And since I cannot use the machine, can I say future economic benefit is 0? And if the future economic benefit is 0, you cannot call it as an asset now. You cannot recognize the asset. And if you cannot recognize the asset, whatever amount you have paid, entire 4 lakhs is a loss for you. So now tell me the treatment. So the entire 4 lakh will be transferred to profit and loss account debit side. Balance sheet, nothing will come because future economic benefit is 0 for that. With that, we are done with the summary of accounting standard 10. Yeah, now let us move on to accounting standard 4. This particular standard deals with contingencies and events occurring after the balance sheet date. So if you look at the title, we are covering two topics, contingencies, and the second one is event occurring after the balance sheet date. This particular thing, contingency, After introducing AS 29, this particular portion will be covering more of AS 29. So mainly our focus will be only on event occurring after balance sheet date. Okay. Now, let's say your balance sheet date is 31st March. And that 31st March balance sheet will not be approved immediately now. So that will be approved in the board meeting. So let's say the board meeting is happening on 30th of June. Now, so balance sheet date is 31st of March. Approval of accounts is happening on 30th June. Between 31st March and 30th June, if any event occurs, that event is called as event occurring after balance sheet date. So what is the meaning of that? It is any significant event. It can be favorable event or unfavorable event, and that should occur after the balance sheet date, but before approval of accounts. Okay. So to call it as an event occurring after balance sheet date, it has to be strictly between date of balance sheet and date of approval. So it should happen in between. If it is happening after the date of approval, it will not come under the AS4 purview only. This is the first point to be kept in mind. Okay. Now, let's take an example. Balance sheet date is 31st March. It is getting approved on 30th June. In between 31st March and 30th June, on 15th of May, there is a fire occurred in the godown. And because of that, there is a loss of 25th of. That particular event is called as event occurring after balance sheet date. I hope all of you understood the meaning of that. Now the question arises. So if the event is occurring after balance sheet, but before approving the accounts, that event should be adjusted in the current year only or should be adjusted in the next year? That's the main question. And to decide that, for that purpose, AS4 divides the activities into events into two types, either adjusting event or non-adjusting event. So can I say the events occurring after balance sheet date can be either adjusting event or non-adjusting event. And very simple, if it is adjusting event, the standard says you should adjust in the current year only. If it is non-adjusting event, you should not adjust in the current year. You should only disclose in the current year. You're going to adjust only in the next year. Okay, that much you understand first. So the events are classified into adjusting, non-adjusting. If it is adjusting, adjust in current year. If it is non-adjusting, don't adjust in the current year. You're only going to disclose. So all that is okay. But what is the meaning of this adjusting event? What is the meaning of non-adjusting event? Now, let us get into that. Now, adjusting event means what? This refer to any event whose condition or situation was existing on the balance sheet date. Okay. And if the condition or situation was existing on the balance sheet date, that requires adjustment. It requires what? Adjustment in the value of assets and liabilities. In which year I should do that? Current year only. In the current year only. Now, let's give an example. Try to understand. So in our example, what is the date of balance sheet? 31st of March. Date of approval, 30th June. On 18th April, one customer became insolvent. 4 lakh rupee I am supposed to get. That fellow became insolvent. Now, if a customer is becoming insolvent on 18th April, can I say that's happening between balance sheet date and approval date? So this fellow becoming insolvent is an event occurring after balance sheet date. But now the question arises, whether that is adjusting or non-adjusting. For that, understand, see if a customer is becoming insolvent, will it happen all of a sudden? No, right? See, the insolvency is normally a slow process. So if you are declared insolvent on 18th April, can I say that even on 31st of March, the financial position might be weak? Which means the situation or condition of the financial weakness was already there on the balance sheet date. And since it was already there on the balance sheet date, I'll call it as adjusting event. And because it is adjusting event, I should adjust that in which year itself? Current year only. Which is this 4 lakh rupee bad debt. Will you book it in the next year or will you recognize in current year itself? Current year only. I hope all of you are understanding. So when I book the bad debt, the entry will be bad debts account debit to debtor. So that way debtor asset value will reduce. Now just read the explanation. So this bad debt should be recognized in current year only. And what is the reason? Customer will not become insolvent suddenly. It's a slow process. So if the customer is insolvent on 18th April, we can assume that the financial position was weak even on 31st March. And because of that, it is a existing on balance sheet date. Therefore, it is adjusting event. Are you all with me? Okay. Now, what is non-adjusting event? These refer to events whose condition or situation not existing on the balance sheet. And since it is not existing on the balance sheet date, in the current year, I should not do any adjustment. It do not require any adjustment. It requires only disclosure, which is in the current year, don't adjust anything. You're only going to disclose in the notes to accounts. Whenever I say disclosure, where will you disclose? Notes to accounts. Okay. Let's take the example, a small change in the example. Balance sheet date is 31st March. Approval date is June. On 18th April, customer became insolvent. But look at the reason why he became insolvent. Because of fire in the godown. Which means the financial weakness, was it existing on the balance sheet date or suddenly it came up? Suddenly it happened now. Which means on the balance sheet date, the financial weakness was not existing. Therefore, it becomes a not adjusting event. It's a non-adjusting event. Okay, not existing. It's a non-adjusting event. And because it is a non-adjusting event, I'll only disclose in the current year. I don't recognize any bad debt in the current year. I hope you got the entire discussion. So, quick summary. So, the event should happen when? Between balance sheet date and approval date. And these events are classified into adjusting, non-adjusting. If it is adjusting event, you adjust it. If it is non-adjusting event, you disclose that. Is that clear? Now, classify the following into adjusting events and non-adjusting event. Some examples are given to you. Just quickly go through that. For all the example, common thing, balance sheet date is 31st March. Approval date is 30th June. Okay, first one. Customer became insolvent. Nothing is given now. Simply it's given he became insolvent. So what is our assumption? So insolvency is a slow process. So we can assume that a financial weakness was there even on the balance sheet date. So what kind of event is that? Adjusting event. I'll book the bad debt in the current year only. Example number 2. Customer became insolvent on 22nd April because of the fire. So suddenly he became insolvent. So on the balance sheet date, the situation was not there. So this is adjusting or non-adjusting? Non-adjusting event. So you will only disclose the bad debt in the current year. You'll book the bad debt in next year. Okay, next one. Fall in the market price of investment on 25th of May. So if the market price is falling, can I say market price will change every single day due to market volatility? So that fluctuation has got nothing to do with 31st March situation. Which means, can I say the situation of fall was not existing on the balance sheet? It happens on a usual basis, correct? So this is also which event? Non-adjusting event. I'm going to ignore non-adjusting event. I'll only disclose that. I cannot adjust it. Next, point number 4. Cash stolen by the cashier on 28th March. Before the balance sheet date only is stolen. However, when we identify 20th April, which is even though you identified on 20th April, before the balance sheet date itself, the money was stolen. Which means, can I say the situation was already existing on the balance sheet date? So this is going to become which event? Adjusting event. So when will you book the loss? Current year only I should book the loss. Okay. Next. The next two examples are very, very important. I want you to observe carefully. Next example. You are received a check from the customer. When are you receiving? After balance sheet date. So you are receiving the check when? After balance sheet date. Let's say 7th April I got the check. But what is that check dated 28th March? Sir, even though the check is dated 28th March, when did you receive it? After balance sheet date. So because you received after balance sheet date, on the date of balance sheet, I don't have any check on my hand. So check date may be 28th March. Don't look at the check date. You need to look at when you received it. In this example, when are you receiving it? After balance sheet date. And since you are receiving it after balance sheet date, on balance sheet date, there was no checks on hand. And since there was no checks on hand, this becomes non-adjusting event, which is whatever collection you have, whatever checks you collected, all that I'll be accounting in which year? Next year. Is that clear? Now look at last example. Received a check from customer before 31st March. So when are you receiving the check? Before 31st March. But what kind of check it is? Post-dated check. Now what is the meaning of a post-dated? Let's say the check date is 7th April. Can I say it's a post-dated one? So check date is 7th April. But when are you receiving the check? 31st March. So our focus should be on the check date or when we are receiving. So look at when you are receiving. So when you are receiving it before 31st March. So if you're receiving it before 31st March, on balance sheet date, you already have a check on hand. So since you already have a check on hand, that will be called as adjusting event. So the collection will be adjusted in which year? Current year only. So in the last two example, what is important? So should I look at check date or the date of receiving that? So the focus should be date of receiving the check. Sir, if you receive the check before balance sheet date, adjusting event. If you receive the check after balance sheet date, non-adjusting event. Is that clear? Okay. Now let us discuss few practical questions. The answers are already given you. So I just gave the hint. You should be able to build up the story. Okay. While preparing the accounts for the year ending 31st March 2010, a company made a provision 4% on debtors. Okay. As per the previous year trend. In the first week of March, debtors suffered heavy loss. Okay. When now? March only. Okay. And there is no insurance policy available. In April 2010, that debtor became bankrupt. Now you tell me, even though he became insolvent in April, can I say in the month of March only he suffered heavy loss, which is on the date of balance sheet, already the financial weakness was there. And since the financial weakness was already there on balance sheet date, can I say it's an adjusting event? And because it is adjusting event, a loss will be recognized in which year? Current year itself, and debtors has to be reduced in the balance sheet. I hope all of you are clear. Okay. Next, question number 2. A company invested 50 lakhs in the acquisition of another company doing similar business in April 2010. So when are you investing? April. The negotiation just started. Negotiation just started. How will you deal with this item? So when the negotiation started, April. Investment also made in April, which means as on the balance sheet date, there is no evidence that conditions were existing. So if there is no condition existing, what kind of event is that? Non-adjusting event. And if it is non-adjusting event, what should I do? Only disclosure is required. And because the amount is big, if you want, you can show in the board of directors report. But remember, board of directors report is not a part of accounts. So accounts only simply showing notes to accounts. Board of directors report, if you want, you can show that. Is that clear? Okay, question number 3. Cashier of Zynga Limited has stolen 6 lakh rupees during March 2012. So when is the theft happening? March. However, it came to the notice in April. What should I do? Simple. So even though you got to know in April, before the balance sheet, the situation is already existing. So what kind of event is that? Adjusting event, because conditions were already there on the balance sheet date. So the loss will be recognized immediately in the current year itself. Is that clear? Okay, we'll move on to example number 4. Okay, the cashier of Zynga Limited has stolen a cash of 6 lakhs during March 2012. However, it comes to the notice of the management when? After the approval of accounts, already approval is also done. So can I say now this is out of the purview of AS4? How will you deal with? So because it is noticed after the approval, it does not come under AS4. So logically, because the approval is already done, when will you book the loss? When will you book loss? Loss will be recognized in current year or next year? Next year only. So current year la book panna mudiyadhu. You cannot book it in the current year. The reason being current year accounts are already finalized now. Now you cannot change it. So I'll book the loss in which year? Next year. And one more thing you should remember, any cash stolen is an extraordinary item as per accounting standard 5. So that requires special disclosure also. I hope all of you are getting that. Okay, next. Question number 5. Okay, this is a very nice question. Some good adjustments are there. Understand carefully. Neil Limited has a corporate office in Mumbai and they sell products to stockists all over India. Okay. So they have office in Mumbai, branches all over. On 31st March 13, company want to recognize the receipt of checks bearing date 31st March or before. So what is the date of the check? 31st March or before. That is the date of the check. And they want to show that as checks in hand. And they want to reduce a trade receivable. So the entry will be checks in hand account debit to trade receivable. And this checks in hand, they want to recognize in the balance sheet like a cash equivalent. And all these checks are presented to the bank in which month? April. Identify whether the following are adjusting or non-adjusting. Understand carefully. First, where is the head office located? Mumbai. And we are receiving the check. What is the date of the check? 31st March or before 31st March. That is the date of the check. But when are we receiving the check? That is not given. See, what is given is the date of the check, but when are we receiving? That is not there in the question. So the check may be received before balance sheet date or the check may be received after balance sheet date. We don't know now. So you have to answer both. So if the check is collected before, on or before balance sheet date, you have to look at the date of receiving the check now. So if you are collecting on or before 31st March, then what we will do? Okay, what is the hint given? Marketing people are employees of the company. And when are the checks were received? Before 31st March. And if you are receiving before 31st March, can I say value of debtors has to be reduced? Which is even though the check is collected in April, in March itself, we have an evidence that the check is there on the hand now. Check is there on the hand. Therefore, what kind of event is that? Adjusting event. And because it is adjusting event, I should reduce debtors in which year? Current year. Similarly, if the check is received, the check is sent by stockist on or before 31st March. But when is the check received? April. So if you're receiving it in April, on the balance sheet date, there was no check on hand. So on the balance sheet date, if there's no checks on hand, then it will be non-adjusting event. Then it requires only disclosure. So the main point you have to understand, when did you receive the check? So if you received it before 31st March, adjusting event. If you are receiving the check in April, non-adjusting event. Is that clear? Okay, next. Okay, point number. Okay, next question. Okay, before discussing the next question, a very, very important point you should remember. Let's say during April, there is a major fire accident in my factory. Because of that, most of the assets are gone. Now, management is not confident about continuity of the business. And if the management is not confident, then you have to prepare accounts on which basis? Liquidation basis, as per accounting standard. And whenever your management is not confident about going concern, any loss will be treated like adjusting event only. Because you cannot postpone the loss to next year. Sir, you need to recognize the entire loss in this year only because the business will not be continued now. You cannot take it to next year. Which means whenever going concern is in danger, it is always going to be adjusting event. Remember that. Is that clear? Okay. Now look at example number 6. A major fire occurred on 5th of April, damaging 10 crores. Out of this, 7 crores is insured. Sir, if 7 crores is insured, can we say going concern is not in danger? No, not in danger. Now, how do you treat it? So obviously, it is an event after balance sheet date. No conditions on the balance sheet date. Therefore, it is non-adjusting event. Therefore, loss will be recognized in which year? Next year only. Okay. However, you mention about that ACE4. If any event represent unusual changes affecting the existence of the enterprise, existence not but going concern, then the special disclosure is required. Okay. Anyway, you can ignore this point. In this particular example, there's no impact now because insurance is available. So going concern is not in danger, which is simply what kind of event it is? Non-adjusting event. So when will you book the loss? Next year. This year I'll not adjust it. I'll only disclose that. Is that clear? Okay. Look at question number 7. Now very important. Accounts are prepared on 31st March 18. Approved on 30th April. 15th April, there is a major fire occurred. The loss is of very high magnitude and management feels that it is impossible to start the business once again. Now can I say going concern is in danger? And whenever going concern is in danger, you have to prepare accounts on which basis? Liquidation. And even though there is no condition existing on balance sheet date, it must be treated as adjusting event only. Very, very important point. Remember that. Okay. Okay. So whenever going concern is danger, it's always which event? Adjusting event. Okay. And in the given case, the chances of continuing the business is very remote. What is the meaning of bleak? Remote. And so accounts need to be prepared on which basis? Liquidation basis. Just keep that in mind. So with this, we are done with the quick summary of accounting standard 4. Now let us move on to page 26. This standard deals with intangible asset. Now what is the meaning of intangible asset? Can I say any asset without any physical substance? And that should give you future economic benefit. And if you want to recognize any intangible asset, there are two important conditions. See, these are the same conditions which are there in accounting standard 10 also. So if you want to recognize any asset, the first thing, the cost of the asset should be reliably measured. You should be able to measure the cost. And second condition, there should be future economic benefit. If both the conditions are satisfied, then only you can recognize an intangible asset. Okay. Now, in this particular standard, from examination point of view, only two topics are important. I'll be focusing on that. The first one is amortization of intangible asset. Now, what is the meaning of amortizing? Can I say spreading the cost of the asset? Now, how do you spread the cost of the asset? For that, there are two cases. Case one, if the future economic benefits are measurable. So, if the future benefits are measurable, then what I'll do, whatever is the cost of that asset will be amortized over the in that ratio of the benefit. Now, take an example. What is the cost of the patent? 80 lakh. And from that patent, they gave you the future economic benefit is given to you. So the future benefits are measurable. I'll do in which ratio? In the ratio of the benefit. So if I simplify all this, what is the ratio? 10 is to 15 is to 12 is to 13. So now can I say the amortization is going to be 80 lakhs is the cost into 10 divided by what is the total of all this? 25, 37, 50. So can I say the amortization is going to be 16 lakh? So in year number 1, it's going to be 16 lakh. In year number 2, 18 lakhs into 15 by 50. Can I say 24 lakh? This is for year number 2. And for year number 3, 80 lakhs into 12 by 50. So can we say, so the amortization for third year is going to be 19.2 lakhs. And similarly, for the last year, you find out 80 lakhs into 13 by 50. Very simple concept, which is whenever the future benefits are measurable, amortization will be in the ratio of that particular benefit. Sir, what if the benefits are not measurable? So if the benefits are not measurable, very simple. I'll simply take original cost divided by life of that asset. After equally, I'll spread it. But a very important point, there is a reputable presumption that the maximum life is only 10 years. Which means in the question, if life is less than 10, you take the less than 10. But if it is given more than 10, you should not take it as more than 10. What is the maximum life I should take? 10 years. Okay, I hope all of you are understanding that. Let's say cost of the patent is 8 lakh. In the question it's given to you, life is 12 years, but should I take 12 years or 10 years? 10 years I should take, so the amortization is going to be 80,000. So the life can be less than 10 years, but it cannot be more than 10 years. You have to remember this phrase. So there is a reputable presumption that maximum life is how many years? 10 years. Okay. Now, an example is given to you. Just go through the example. Okay. A company purchased a patent costing 450 lakh when they bought it 1st April 2002 and started amortizing over 15 years, which is a mistake. Okay. On 1st April 2005. So how many years over? 2 to 3, 3 to 4, 4 to 5. So 3 years over. Now, what is the value of the patent? 360 lakhs. Is the treatment correct? Totally incorrect. Because what is the maximum life I should take? 10 years. But they have taken how many years? 15 years. So what should I do now? Now what I should do? Very simple. Already how many years is over? 2 to 5. How many years is over? 3 years over. So I should take the life as 10 years. Out of that already 3 years is over. So I'll take the remaining life as 7 years. So simply what I'll do, I'll take 360 lakh and I'll spread that over the remaining 7 years prospectively. Okay, this is what I should do now. So can I say 360 divided by 7? So from this year onward, I'll be amortizing how much? 51.42 lakhs every year. Okay, so with this, we are done with amortization concept. So very simple. If you can measure the benefit, take the ratio. If you cannot measure the benefit, take the life. And what is the maximum life I should take? 10 years. It can be less than 10. It cannot be more than 10. Is that clear? Okay. The next important concept, very, very important from examination point of view. How do you treat research and development cost? Research and development. So can I say, if I'm doing any research, during the research phase, you are trying to find out the feasibility of a product, correct? So if you're trying to find out whether the product is feasible or not, can I say research can be successful or research can be a failure also? And if research can be a failure also, future economic benefit, there is no probability now. Sir, I don't know. The benefit may come, may not come. And if the future economic benefits are not confident, not probable, now can you recognize the research expense as an asset or you cannot, right? Because future benefit is not guaranteed. And because it is not guaranteed, the entire research expense is always transferred to profit and loss account. So remember, so research is always transferred to profit and loss account only, irrespective of the amount involved. Now look at this. So research phase. So what is the purpose of research? To find out feasibility, and expenditure will not be recognized as an asset. The entire amount will be transferred to P&L. What if it is development? Can I say development starts where research ends? Correct, about development you are starting only if the research is successful, which means future economic benefit may be there now, it may be there. So development expenditure can be recognized as an asset, it can be recognized as an asset. But if you want to recognize this development expenditure as an asset, there are some conditions, there are some conditions, and these conditions are given under para number 44, and all the conditions you must satisfy. If all the conditions are satisfied, you recognize that as an asset. And if the conditions are not satisfied, even development expenditure will go to profit and loss account. Are you all there? Now, what are those conditions? Very simple theoretical points. You can just understand that. First, there should be technical feasibility of completing that asset. You should have intention to complete. You should have the ability to use the asset. You should have adequate resources to complete that. If all these are satisfied, then only development phase will be shown as an asset. Is that clear? So the conclusion here, research expenditure always P&L. Development expenditure can be recognized as an asset only if the conditions are satisfied. Is that clear? Now, the question is, how much you can capitalize? Sir, you cannot capitalize the entire development expenditure. There is a limit for that. How much you can capitalize? Least of the following. What is the first one? Cost incurred. Let's say you have spent 10 lakh rupees for development. So what is the actual cost incurred? 10 lakhs. That you should compare with the present value of the future economic benefit. Let's say from this 10 lakh, I'm expecting benefit for the next 3 years. And if I find out the present value of all that benefits, let's say it's coming to 9 lakh. Now the standard says you have to take whichever is lower in the balance sheet. So even though the actual expenditure is 10 lakh, what is the present value of the benefit? 9 lakh. Which is in balance sheet, I'll recognize only how much? 9 lakh. The difference of 1 lakh will be debited to profit and loss account like a loss. Now let us try to understand this with the help of an example. Look at the example given here. A company incurred 400 lakhs on development. So can I say this is the actual cost incurred? Future economic benefit for the next 3 years is given to me. That is 150 lakh, 150 lakhs, 150 lakhs. Can I say this is an annuity? So same 150, 150, 150 every year. So whenever this annuity here, can I simply say we'll multiply this 150 lakhs with the present value annuity factor. So find out that at 10%. So can I say 1 divided by 1.1 for 3 years? So can we say 150 lakhs into 2.489, sorry, 487. So if you multiply, so what is the present value you are going to get? So what is the present value? 373 lakhs approximately is the present value of the future economic benefit. But what is the actual cost incurred? 400 lakhs. So compare both. So cost incurred is 400. Present value approximately 373, whichever is lower. Which is how much will be recognized as an asset in the balance sheet? 373 lakhs only. This 27 lakh difference will be debited to profit and loss account like an expense. Okay. So these are the main concepts in accounting standard 26. Yeah. Now let us move on to accounting standard 16 that deals with the treatment of a borrowing cost. Now, what is the meaning of borrowing cost? Let's say you take a loan. The loan is a borrowing. And when you take a loan, you have to pay interest, which is a borrowing cost. And let's say I'm issuing debenture, which is a borrowing. And when there's an issue of debenture, there can be premium on redemption, which is a borrowing cost. Similarly, let's say you're buying an asset on hire purchase. And when you're buying an asset on hire purchase, you have to pay interest now. In case of finance lease, you pay interest. And can I say that interest is a borrowing cost? Which is the word borrowing cost is a very wide term. So any cost associated with the borrowing is normally called as borrowing cost. So this particular standard is going to deal with the treatment of borrowing cost. Now, what is the meaning of borrowing cost? Any interest and any other cost in connection with the borrowing is called as borrowing cost. Now, what are the different examples for that? There can be interest charges on borrowing, any amortization of premium related to borrowing, like loan processing fees. So let's say you're taking a loan. When you're taking a loan, initially there is something called loan processing charges now deducted from your account. And that loan processing charge is like a borrowing cost. Similarly, there can be any finance charges in respect of hire purchase. If you remember AS 19, in case of finance lease, there is going to be some interest now. Can I say that interest is also like a borrowing cost? Okay. Now, borrowing cost is a very wide term. But as per accounting standard is concerned, our main focus is going to be on interest. Interest. Now, the question arises, how do you treat that interest? How do you treat the borrowing cost? Say, normally when you pay interest, what is the entry? You pass an entry, interest account debit to bank account. And interest is normally transferred to profit and loss account debit side, correct? Which is in most of the cases, interest will be like revenue expenditure, will be transferred to P&L. But there is only one exception to that. Only one exception to that. And what is the only exception? If the borrowing is related to acquisition, construction, or production of a qualifying asset, then what I will do, that borrowing cost will be capitalized. What is the meaning of capitalizing? You will not transfer the borrowing cost to the P&L account. Instead of that, you will add it to the asset cost. That is the only exception. So when will you capitalize? There should be qualifying asset. If it is other than qualifying asset, so whatever borrowing cost you have will be transferred to profit and loss account because it is a revenue expenditure. This is the main gist of the entire standard. Okay, so if it is acquisition, construction, or production of a qualifying asset, then only you will capitalize. So now the question is, what is the meaning of this qualifying asset? Now, as per the standard, any asset which takes substantial time to get ready for the intended use can be called as a qualifying asset. Okay. Now, what is the meaning of this substantial period of time? Normally, in the practical scenario, we take anything 12 months or more than that as substantial period of time. But sometimes more than 12 or less than 12 also can be taken as substantial based on circumstances. But normally 12 months. Is that clear? So if the asset is taking substantial time to get ready, then it's called as qualifying asset. Now let's take an example. Look at example number 1. What you're doing, you're buying a building. A building is purchased by taking loan 20 lakh. And on that loan, what is the interest you are paying? 10. Now tell me, so 20 lakhs, 10%, now you're paying how much? 2 lakh. This 2 lakh rupee interest will be added to the building cost or transferred to the P&L. So now tell me, is it qualifying asset? No, right? Because you are buying the building. So if you are buying the building, is it taking substantial period of time to get ready? No, it's readily available. Which is in this case, it's a qualifying asset or non-qualifying? Non-qualifying. And when it's non-qualifying, the entire 2 lakh interest will be transferred to profit and loss account. Okay, now look at example number 2. A building is constructed by taking a loan. Now we are constructing a building. The interest is given as 10%. The construction is completed at the end of 2 years. So can I say I'm taking year 1 and year 2, 2 years time to construct the asset? So can I say it's taking substantial period of time to get ready? Which is, can I say in this example, building is a qualifying asset? And because it is a qualifying asset, whatever interest you have paid for year 1 and year 2, you paid how much? 2 lakh plus 2 lakh. This entire 4 lakh will be capitalized. Is that clear? So in first example, profit and loss account because it's non-qualifying. In second example, I will capitalize because it's qualifying. Is that clear? Okay. Now, what are the conditions for commencement of the capitalization? What are the conditions for capitalizing? Now, first condition you already know. The first condition you already know. What is that? It should be related to qualifying asset. The second one, the activities related to complete the qualifying asset must be in progress. So let's say I've taken a loan. I want to use that loan and construct a building. During the first year, now construct a panel. I have not done the construction. If I have not done any construction in the first year, can I say there is no activity? And even though there is no activity, interest I am supposed to pay now. And that interest, will I add in the building cost or should I take it in P&L? Sir, I should take it in P&L. Because you cannot add it in the building cost because you did not start the work only. Sir, without starting the work, if you add it in the building cost, in the balance sheet, building will be shown. But where is the building? You have not done any work only. Which means if the activities are not started yet, the entire interest will go to P&L only. So what is the first condition? The activities to complete the asset must be in progress. Is that clear? And second one, obviously the borrowing cost should be incurred. Okay, let's look at the example. You have taken a loan of 20 lakhs. First year, no activity. Okay, so 20 lakhs, 10%. So how much interest I'll pay in first year? 2 lakh. This 2 lakh, because there is no activity, will be transferred to P&L. Construction is completed in second and third year. So second and third year, I'll be paying 2 lakhs in second year, 2 lakhs in third year. This 4 lakh will be capitalized because the activity is in progress. Okay, I hope you're getting that. So in our example, first year, how much is the interest? 2 lakh. That will go where? P&L. Second and third year put together, how much is the interest? 4 lakh. And that 4 lakh will go to P&L or you will capitalize that? You will capitalize that. From fourth year onwards, because the asset is already ready, construction is over now. So from year number 4 onwards, again the interest will go to P&L. I hope you are getting that. Because once the asset is ready, you cannot go on adding the interest. So interest will go to P&L. Which is you can capitalize interest only as long as the work is in progress. And once the work is done, once it is completed, then you cannot capitalize. Is that clear? Now, let's move on to the next one. Suspension of capitalization. Okay. Sir, when will you suspend? What is the meaning of suspending capitalization? Suspend is nothing but temporary stop, temporarily stopping the capitalization. Now, let us say I'm doing one building construction. I'm taking one loan and doing one building construction. First 9 months, activities in progress. Last 3 months, because of the natural calamity, I could not do any work. So even though there is no work, I should pay interest for the full year now. So I should pay interest for the entire 12 months. Now in the last 3 months, there is no activity. So now tell me that last 3 months interest, should I capitalize it or I should not capitalize it? So in this example, why the activity was not done? So the activity was interrupted due to natural calamity, which is unavoidable reason. That's not my mistake. And because it's not my mistake, because it is due to unavoidable reason, the standard will allow you to capitalize. You can add the interest in the asset cost only. Because if you put the interest in profit and loss account, what will happen? Your profit will come down. But there is no mistake from your side now. So when there's no mistake from your side, the standard is giving an exemption to you. Don't put it in the profit and loss account, add it to the asset cost only. Is that clear? Which means in simple words, if the activities were interrupted due to unavoidable reason like natural calamity, what should I do? Continue the capitalization. Is that clear? Second, if the activities were interrupted due to avoidable reason. The same example, let's say, last 3 months there was labor strike, and because of the labor strike, there was no activity. Now, can I say labor strike could have been avoided? No. Sir, if I paid better wages, they would have come and work. Which is, this labor strike was an avoidable reason. It's my mistake not to do the work. So now what happens? The 3 months interest will be transferred to profit and loss account, which is temporarily capitalization is going to be suspended. The 3 months interest will be transferred to P&L. Okay. Now, one last example. Let's say you're constructing a house. So when you're constructing a house, first you lay the foundation. Sir, once the foundation is done, you don't start erecting the walls immediately now. Few months, you will just leave that foundation so that it gets stronger. Which is, for 1 or 2 months, there is no activity. So can I say that no activity is also a part of the construction process? Which is, if the activities were stopped as a part of the construction process, then also capitalization will continue. I hope all of you are clear. Okay. The next topic of this accounting standard 16 is very, very important from examination point of view. How do you treat borrowing cost if loan is taken in the foreign currency? Foreign currency, a very important point. So I'll give an example, try to understand, focus carefully. Let's say you need a loan of 80 lakh rupees, let's say. So what is the loan amount required? 80 lakh. This loan, if I borrow in India, the rate of interest is 14%. So I'm supposed to pay 14%. Same loan, if let's say if I borrow in US, I'm supposed to pay 6% interest. Okay. So in India, 14%. US, how much I'm supposed to pay? 6%. Okay. How much money I need? 80 lakh. Now the exchange rate, beginning of the year, let's say 80 rupees. End of the year, the exchange rate become 89 rupees. Okay, this is the information given to you. Now listen carefully. How much loan I want? 80 lakh. This loan, if I take it in India, so can I say my loan amount will be in rupees now? So in that case, your loan will be 80 lakhs. On that 80 lakhs, how much interest should I pay in India? 14%. So I'll calculate the interest. So how much is that? 80 lakhs into 14%. So in that case, I'll be paying 11 lakh 20. Correct about 80 lakhs on that 14%. So I'll be paying 11 lakh 20,000 interest if I take the loan where? In India. Same loan, if I take in US, in foreign currency, I mean to say, then in that case, my loan will not be in rupees. My loan will be in which currency? Dollars. So can that say loan will be 80 lakh rupees divided by, at the beginning, how much was the rate? 80 rupees. So 80 lakh divided by 80. So what will be your loan amount in that case? $1 lakh. Are you there? So if I take the loan in foreign currency, it's going to be in dollars. So how much is the loan? $1 lakh. Now on that $1 lakh, first thing what I should pay? I should pay interest now. Now in US, what is the foreign currency interest here? 6%. So $1 lakh, I should pay 6%, and now $6,000. And that $6,000 I should pay. When will you pay interest? Year beginning or year ending? Year ending. And if you're paying in year ending, so what is the exchange rate I should take? Year ending rate. How much is the year ending rate? 89. So calculate that. So 1 lakh into 6% into 89 rupees. So how much is the interest I'm supposed to pay? 5 lakh 34,000. I hope all of you understand. Which means if I take the loan in India, my interest is 1120. But if I take the loan in foreign currency, my interest is only 5 lakh 34. My interest is going down. Just even though my interest is going down, if you observe here, when the loan was taken, exchange rate was 80. But year ending, the exchange rate became 89. So the loan is a monetary item. As per AS 11, loan is a monetary item. And monetary item has to be restated now. End of the year, you have to recalculate the monetary item. Which means from 80 rupees, your loan became 89 rupees. And now there is an increase in loan. I hope all of you are understanding. There is some increase in loan. And how much is that increase in loan? $1 lakh into 80 became 89. So how much is the increase? 9 rupees. So 1 lakh into 9. Can I say 9 lakh? Which means because you took the loan in foreign currency, you are paying 5 lakh 34,000 interest. That is one burden. In addition to this burden, you have another extra burden. What is that? Your loan also has gone up now. From 80 it became 89. Which is what is your total burden now? 14 lakh 34,000. This is my total burden. Now what the standard says? This total 1434 you divide into 2. You divide that into 2. What is that? Whatever is the interest that you would have paid in India. So how much you would have paid in India? 1120. That 1120 will be treated like a borrowing cost. Will be treated like a borrowing cost as per AS 16. Very important. Very important. So 1120 is borrowing cost. And what is the balancing figure? 14 lakh 34,000. From there you remove 11 lakh 20,000. So what is the balance? 3 lakh 14,000 extra you get. This will be treated like exchange loss as per AS 11. I hope all of you are getting that. So a quick summary, I'll explain this once again. So first what you do, find out interest in India, 1120. But in foreign, there are two burdens. Interest is also there. Loan is also going up. Total both, 14 lakh 34 is your total burden. In that 14 lakh 34,000, you take whatever is the interest in India, that is called borrowing cost. Whatever extra you are incurring, that extra is called exchange loss. I hope all of you are understanding. This is how you treat whenever loan is taken in foreign currency. Is that clear? Okay. So with that, we are done with topic number 6. Now, let us get into few practical questions. A company obtains a bank loan. What is the loan amount given? 50 lakh. This 50 lakhs will be utilized like this. Construction of shed, buying one machinery, working capital, advance for buying a truck. Total interest is given to you 9 lakhs. Explain the treatment. A very simple question. Can I say total interest is 9 lakh? Total loan is 50 lakh. So can I say 9 lakh by 50 lakh? What is the rate of interest? 18%. Correct. First, I'll find out the rate of interest. 18% is the rate of the interest. Now, there are different purposes. How many purposes are given to you? 4 purposes. So 4 purposes. So what is the first purpose? Construction of shed. So if we are using for construction of a shed, can I say it might take substantial period of time? And if it's taking substantial period of time, what is that? Qualifying asset. So if it is qualifying asset, what will you do? In the first example, you are going to capitalize the interest. So 20 lakhs. So what is the rate of interest? 18%. So 20 lakhs la 18%. So how much you get? 3.6 lakh. And tell me the treatment. This 3.6 lakhs will be revenue expenditure or capitalize? Capital. Shed cost law, you will include it. Second one, purchase of the machinery. So if you are buying the machinery, that will not take substantial time now. You are buying it, so it's not taking substantial time. So it's a qualifying one or non-qualifying? Non-qualifying. And if it is non-qualifying, will you capitalize or revenue? Revenue. Profit and loss account la transfer பண்ணுங்க. So 15 lakhs on that 18%. So how much you get? 2 lakh 70. And the 2 lakh 70,000 will be revenue expenditure, will go to P&L. Next. Working capital. What is the meaning of working capital? For meeting my day-to-day expense. So there is no asset only involved. So 10 lakh into 18%, how much you get? 1.8 lakh. This is also again revenue expenditure. Next, you are giving advance for purchase of truck. So what is the purpose of the loan? You are using it for advance. And giving advance will not take substantial period of time. So this is also non-qualifying. So this also will be revenue expenditure. So 5 lakhs on that 18%. So how much is that? 90,000. That is also revenue. Is that clear? So first you need to identify whether it is qualifying asset or not a qualifying asset. I hope this is clear. Okay. Okay. There's one more very important concept in AS 16. That is nothing but treatment of special borrowing and general borrowing. First, let me explain that concept. Then I'll come to this particular example. Okay. Special borrowing, general borrowing. See, from the name you can understand. Special borrowing means what? borrowing made for a special purpose, specific purpose, and general borrowing is a non-specific purpose. Which is whenever you are using any loan, first will you utilize general borrowing or first will you utilize specific borrowing? So always first we try and use specific borrowing. No? If the specific borrowing is not adequate, then only we are utilizing general borrowing. That is a basic understanding you should have. Now let us take one example straight away. This is a very, very important example. I want you guys to please mark it important and focus on that. Okay. Mr. Ayush Limited began construction of a new building. Okay. January 1st, they started. And they have taken a 3 lakh rupees special loan. Special loan. So can I say this is special borrowing? And what is the rate of interest for that? 12%. Apart from this special loan, they are having two general loans also. 6 lakhs one is there, 11 lakh one is there. So can I say there is one special borrowing and two general borrowing? This expenditure on the building is given to you. So you are incurring some expenditure on one date or different dates, different dates. And finally, when did you complete the building? Year ending. So can I say it's a qualifying asset taking 12 months time? Calculate how much interest will be capitalized and also pass the journal entry. Okay, now listen. First thing, okay, understand this. We know the expenditure dates. So we know January 1st. Okay, we'll directly write it here only. So January 1st, 3 lakhs is incurred. Now this 3 lakh rupee expenditure, I would have taken from which borrowing? Can I say specific borrowing? And what is the specific borrowing amount? 3 lakh. So can I say this entire 3 lakhs is taken from where? Specific borrowing. So on that 3 lakhs, what is the rate of interest I should pay? What is the rate of interest on specific borrowing? 12%. So can I say 3 lakhs into 12%? How much is that? 36,000. Is the first one. Now come to the second one. What is the second expenditure incurred? This is incurred on 1st of April. So this 1st of April, I'm spending 3.5 lakh. So this 3.5 lakh is taken from which borrowing? General now. Because special borrowing totally 3 lakhs is there and completely 3 lakhs is utilized there itself. Which is this 3.5 lakh is taken from where? General borrowing. The first understanding it should be general borrowing. 3.5 lakh is taken from general borrowing. But if you look at general borrowing, there are two general borrowings. So two general borrowings are. So I don't know whether the 3.5 is taken from 6 lakh or whether it's taken from 11 lakhs. Because I don't have one general borrowing, I have two general borrowing. So now what I will do, so since I don't know from where I have taken this, I will find out the weighted average rate of interest. And how do I do that? Look at this general borrowing. 6 lakhs into 11%. How much is the interest? 66,000. 11 lakhs into 13%. How much you get? 1 lakh 43,000. Add both. Can I say 2 lakh 9,000 is the total? And 2 lakh 9,000 is the total. On total principal, how much? 17 lakh. So you're paying 2 lakh 9,000 on total loan of 17 lakhs. So 2 lakh 9,000 upon 17 lakhs. And that will give you the weighted average rate of general borrowings. So can I say 2 lakh 9,000 divided by 17 lakhs. So how much you're getting? 12.29%. Is that clear? So this is the rate of interest I should take on which borrowing? General borrowing. Now come to the second expenditure. So the 3.5 lakh, what is the rate I should apply? 12.29%. Is that clear? Into, when I'm calculating the interest, understand very carefully, when is the expenditure incurred? April 1st. So expenditure is incurred on April 1st. Which means whatever general borrowing you have, the general borrowing you are using for other purposes also now. For the purpose of building construction, are you using for the entire year or only from April onwards? Only from April onwards. Which means with respect to the general borrowing, the interest I should capitalize only for how many months? 9 months. So understand, I'll pay the interest for first 3 months also. But for the first 3 months, you are not using it for building. You're using for some other purpose. So obviously, you cannot add it in the building cost. I should add only for how many months interest? 9 months. Is that getting clear? So calculate that. So can I say 3.5 lakh into 12.29% for how many months? 9 months. So you just do the verification. So you get 32,261 rupees approximately. Now similarly, look at the next one. 5.5 lakh. Can I say this is also taken from where? General borrowing only. So again calculate the interest. 5.5 lakh, 12.29%. And that is going to be capitalized for how many months? 6 months from July to December. So calculate that. So 5.5 lakh, 12.29, 6 by 12. So how much you get? 33,798 rupees approximately. And same way last expenditure. When is the expenditure incurred? 1st of December. And this is also from where? General borrowing only. So I'll write it here. I'm writing it here. So can I say 1.5 lakh? On that also 12.29%. And this is going to be only for 1 month. So find out that. So 1.5 lakh into 12.29 divided by 12. 1536. That's it. Now you find out what is the question they're asking. Calculate the interest to be capitalized. So how much should I capitalize? Add all this. 36,000 plus this plus this plus this. This is the interest to be capitalized. Is that clear? Okay. And there is also one more thing they're asking you. Also pass the journal entry. Now what is a journal entry? Is nothing but you're constructing the building now. Sir, what is the total expenditure on the construction? Add all this. So what is the total? Can I say 3 plus 3.5? 6.5, 7, 12, 13.5. So 13.5 lakhs is the total. In addition to 13.5, this entire interest also I should add in the building cost only. So 13.5 plus add all this, you will get one final figure. For that, you pass one entry, that is building account debit to bank account. Is that clear? So the journal entry will be made for what? 13.5 expenditure plus the entire interest, add everything, that is your building cost. So the entry will be building account debit to bank account. Clear? Okay. Next, question number 3. Okay, there's a question. Bahubali Builders Limited, they borrowed a sum of $10 lakh at the beginning of the financial year. Okay. For residential project. And what is the rate of interest? LIBOR plus 3%. And it's given somewhere in the question. What is the applicable LIBOR? Okay, it's missing here. Let's say applicable LIBOR is 1%. So can I say 1 plus 3? 4% will be the rate of interest in foreign currency. So what is the rate of interest? 4%. If I take the loan in India, what is the rate of interest? 10.5%. Beginning of the year, the rate was 56. End of the year, rate is 62. They're asking you what is the borrowing cost and what is the exchange loss. Hey, this is nothing but the treatment of loan taken in foreign currency. So I'll quickly explain this. I'll divide into India, foreign. If I take the loan in India, how much will be your loan amount? $10 lakh into India loan amount will be in rupees na. So $10 lakh. And what is the year beginning rate? 56. So $10 lakh into 56. So in India, your loan amount will be 560 lakh rupees. Correct? On that loan, I should pay interest. And how much is the interest? 560 lakhs on the 10.5% you calculate. So can I say 560, 10.5%. So how much will be the interest? You'll be paying 58.8 lakh. That's all in India. Same loan, if I take in foreign currency, then the loan will be in dollars. So how much will be the loan amount? $10 lakh. Now there are two burdens. What is the first burden? Sir, you should pay interest now. Sir, how much interest you should pay? $10 lakh. What is the rate of interest? I gave you now 1 plus 3. So LIBOR is 1 plus 3. So can I say 4%? So $10 lakh on that 4% I should pay interest. And that interest I'll be paying at year ending now. So because I'll be paying in year ending, I should take 62 year ending rate to take. So calculate the interest. So $10 lakh in that 4%. So can I say $10 lakh in that 4%? So can I say $40,000? Correct. $40,000 into 62. So in that case, how much interest will be paying? 24 lakh 80,000. This is one burden. And in addition to the interest, there is one more burden. What is that? Your loan is going up. Sir, initially when I've taken the loan, what is the rate? 56. Year ending, what is the rate? 62. So can I say there is an increase in loan also? How much is that? 10 lakh dollars into how much is the increase? 6 rupee. Add that. So can I say there are two burdens now? One is I'm paying interest. Second one, my loan is going up. So add both. What is my total burden now? 84 lakh 80. Okay. Now what does standard say? This 84 lakh 80 I'll divide into two portions. What is the first portion? Whatever is the interest you are paying in India. How much is that? 58.8 lakh. That is treated like borrowing cost as per accounting standard 16. And whatever is the balancing figure, what is the balance you get? This minus this. So what is the balance? 26 lakh. And that will be exchange loss as per AS 11. I hope all of you are getting this point. Okay. Okay, we'll move on to the next example. Question number 4. Okay, before explaining the next example, let me give one point, understand that point, then we'll come back to this example. Let's say I have taken loan 10 lakh. On the 10 lakh, I'm supposed to pay 8% interest. So how much is the interest I'm supposed to pay? 80,000. Okay. Now, the entire 10 lakhs, I won't be using immediately now. So I'll not be spending the entire 10 lakhs immediately for construction. So out of 10 lakhs, temporarily 1 lakh I invested in some FD. On that 1 lakh, let's say I got 6% interest return. So can I say 1 lakh plus 6%? How much am I getting? 6,000. So how much interest I am paying on the loan? 80. And out of that 10 lakh, how much I invested temporarily? 1 lakh. And on that 1 lakh, 6,000 I am receiving now. So effectively, can I say my borrowing cost is only 74,000? Which means whenever temporarily, if you invest the money somewhere, whatever interest you get on that will be adjusted from your borrowing cost. Just keep that point in your mind. Is that clear? Now have a look at this particular example. Example number 4. Okay. Expert Limited issued 12% debentures is to 100 lakh. And what is the date? 1st of June. When is it issued? 1st June. Keep the date in mind carefully. And that money, that 100 lakhs, how they are using, they are given you. Construction of the building, working capital, machinery bought, furniture bought, truck bought. Very direct question. Can I say construction? Qualifying asset. Remaining all purchase, non-qualifying asset. Correct, Abba? The first thing. Interest on debentures was paid by the company. Calculate that. How much is the interest? 100 lakh, 12%. For how many months? When are you issuing debenture? June, na? Which is for the first 2 months. April and May, I'll not pay. So the interest will be for full year or only for 10 months? 10 months. So calculate that. So how much will be the interest on debenture? 10 lakh. Is that clear? So I will be paying 10 lakh for 10 months. And during the year, what the company did, they invested the idle fund 5 lakhs. They invested somewhere. On that 5 lakh, they, in the FD they invested, and how much interest they made? 50K. So I'm paying 10 lakh. But how much am I getting it back from FD? 50,000. So can I say effectively my borrowing cost should be 10 lakh minus 50,000. 9.5 lakh will be my borrowing cost. Are you all there? 9.5 lakh is my borrowing cost. And how do you treat that borrowing cost? Now, can I say this 9.5 lakh borrowing cost, I'm going to spread in this ratio. I'll simply take this ratio. So what is the ratio? Can I say 40 is to 30 is to 15 is to 2 is to 13. In that ratio, you spread the borrowing cost. And whatever you are spreading, whatever is related to the factory building, capitalize. All the remaining revenue. Because factory building is qualifying asset now. So in the first case, 9.5 lakh into 40 divided by, what is the total of all this you're getting? 100. So 9.5 lakh into 40 divided by 100. So can I say 3.8 lakhs? So in the first case, 3.8 lakh, you are going to capitalize. In all the remaining cases will be transferred to P&L account. The calculation part you should be able to take care. Okay. With this, we are done with Accounting Standard 16 revision. Yeah. Now let us move on to Accounting Standard 12. This standard deals with accounting for government grants. So can I say government grant is nothing but you are getting some kind of support from the government. And this support can be in the form of cash or it can be in the form of kind. If you are getting cash, it's called monetary grant. If it is in the form of kind, it's called non-monetary grant. So effectively, there are two types of grant: monetary, non-monetary. Now, how do you do accounting for that is what is important. Now, how do you do accounting for monetary grant? And when I say monetary grant, what is coming in? Money. So bank account is going to be debited. Which account will you credit? And that depends on the purpose of the grant. It depends on what? The purpose of the grant. First one. So if you're receiving the grant for meeting your regular day-to-day expense. If it is regular day-to-day expense, can I say it's like a revenue receipt for you? And if it is revenue receipt, you'll be crediting which account? The profit and loss account. Which is in the first case, the entry is going to be bank account debit to P&L. Second. So if you're receiving the monetary grant, in the nature of promoter contribution, what is the meaning of this promoter contribution? It's like, let's say, I'm starting a company in a backward area. And government says, whatever is my investment, whatever is the cost of the project, 20% they are going to give. So let's say I'm spending 10 lakh, government will give me 2 lakh. As I'm spending 5 lakh, government is going to give me 1 lakh. So can I say the government is acting like a promoter and giving me some capital? So that amount, because it's like a capital amount, I'll be transferring to which account? Capital reserve. So now the entry is going to be bank account debit to capital reserve account. So if it is for regular expense, transfer to P&L. If it is promoter contribution, transfer to capital reserve. And there can be one more purpose, which can be for purchase of the fixed asset. For purchase of the fixed asset. Let me explain this with the help of a flow chart. Let's say you are receiving a grant. And what is the purpose of that? For buying a fixed asset. So if you are buying a fixed asset, there are two possibilities. The fixed asset can be non-depreciable fixed asset like land, or it can be depreciable fixed asset like machinery, furniture, building, whatever it is. So if you're receiving it for non-depreciable fixed asset, so the government is giving you money. And what is the purpose of that money? You want to use it for buying some land, let's say, non-depreciable asset. So if you're getting money for non-depreciable asset, there are two options available. Option number one, you reduce that from the land cost. Let's say I'm paying 20 lakhs and buying the land. And out of 20 lakhs, government is giving me back 5. So can I say effectively the land cost is only 15 lakhs for me? Which is an option one. What I'll write? I'll simply write a bank account debit to land account. So what is option one? Reduce from the cost of the asset. This is your first option. Second option, what you can do is of reducing it from the land cost. Can I say if you're receiving for buying land, is it revenue receipt or capital receipt? It is capital now. And because it is capital receipt, I'll transfer to which account? A bank account debit to capital reserve account. Is that clear? Which is whenever you receive monetary grant for buying a non-depreciable asset, either you can reduce from cost or you can transfer to capital reserve. Let's say, similarly, now we are buying a depreciable asset, let's say machinery or furniture, whatever it is. Even now, the standard gives you two options. Now, option one is same like this. What you can do? Reduce from cost. So you are receiving the grant now, so I'll debit the bank account. And let's say I'll reduce from the machine cost. So the entry is going to be bank account debit to machinery. Second option, option number two. Now what I do, because a depreciable asset has a limited life is limited now. And because the life is limited, we'll transfer to one special account called a bank account debit to deferred government grant. Transfer that. And this deferred government grant, you will spread it over life of that particular asset. Let's say you got 10 lakhs. So the entry will be bank account debit to 10 lakhs. Bank account debit to DGG 10 lakh. Let's say machine life is 5 years. So 10 lakh divided by 5 years. So how much will I transfer to P&L? 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh, like that. I'll spread it over 5 years. Is that clear? I hope all of you are getting that. So this is how you treat monetary grant. So a quick summary. So how many purposes are there? Three purposes. If it is for regular expense, P&L, promoter contribution, capital reserve. If you're buying an asset, you have to verify if it is non-depreciable or depreciable. If it is non-depreciable, what is option one? Credit the asset, cost will reduce. What is option two? Credit the capital reserve. If it is a depreciable asset, option one is same. In option two, you'll credit which account? Deferred government grant and spread it over life of the asset. I hope all of you are clear with that. One example is given to you. I want you guys to try this example because a very simple standard. Don't want to waste much time on that. Okay, we'll move on. What if you are receiving non-monetary grant? So non-monetary grant, government is directly giving you an asset, maybe building, land, whatever it is. If you are receiving a non-monetary grant, there are two possibilities. Either you are receiving at free of cost or you are receiving at a concessional price. So if you are receiving at free of cost, your cost is zero. But even though your cost is zero, you have to show the asset at nominal value. That nominal value. That nominal value should be given in the question. But if nominal value is not given in the question, you take anything between 1 to 100. So for namesake, you show some value, nominal value, and you give a disclosure in notes to account saying that we got an asset at free of cost. Since the cost is zero, we are showing that nominal value. Is that clear? So if you're receiving the asset at concessional price, then show at a concessional price. Let's say market value is 10 lakh, but the government is giving me for 1 lakh. Then I'll show the asset at what value? Concessional price. So what is the concessional price? 1 lakh. So I'll record the asset at 1 lakh. Is that clear? So this is how you treat a non-monetary grant. Next, accounting for refund of the monetary grant. It's very simple. So whatever journal entry you did at the time of receiving a refund, you reverse everything. Let's take an example. First one, refund of grant for meeting expenses. When you got the grant, what is the entry? Bank account debit to P&L. Now when you reverse refund the grant, the entry is going to be reverse P&L account debit to bank. Just reverse that P&L debit. Second one, refund of government grant if it is promoter contribution. So if it is promoter contribution, what is the entry when you got it? Bank to capital reserve. Now the reverse entry, it will be capital reserve to bank. I hope all of you are getting that. Next, refund of government grant if it is for non-depreciable asset. So if it is non-depreciable asset, there are option one and option two. What is option one? You could reduce from cost. If you have reduced from cost that time, at the time of refund, what you should do? Increase the cost. So during receipt, you have deducted. So during refund, what you should do? Add the cost. So how will you add the cost? A reverse entry. So what is the entry going to be? Asset account debit to bank. Asset account debit to bank. Similarly, if you had followed option two, in option two, you would have transferred to capital reserve now. So the entry will be bank to capital reserve. Now it's going to be capital reserve to bank. I hope you're getting that. Next, if the government grant is for depreciable fixed asset, depreciable asset, if I have followed option one, what is option one? Asset cost have reduced. Now what I should do? Increase the asset cost. So what will be the entry for increasing asset cost? Asset account debit to bank. Now comes the most important point, the last one, F, very important. Let's say I bought one machine. I got 10 lakh rupee grant. Life of the machine is 5 years. So machine is a depreciable asset. So I have gone with option number two. So in option two, what I would have done, bank account debit to deferred government grant 10 lakh. This 10 lakh you have to spread over 5 years now. So 2 lakh, 2 lakh, 2 lakh, 2 lakh every year. Let's say 2 years over. So 2 years over, 10 lakh by 5 years. So 2 lakh, 2 lakh. So how much is already transferred to P&L? 4 lakhs. So out of 10 lakhs, already 4 lakhs is gone. Right now, DGG, how much is there? 6 lakh. So let's say third year, if you're doing refund, in third year, if you're doing refund, so what is the entry going to be? Can I say DGG, what is the balance left? 6 lakh. P&L account, what is the balance left? 4 lakh. To bank account, 10 lakhs. So this is the only case where you cannot blindly reverse the entry. You will debit DGG with whatever is the balance left. P&L account, whatever is already transferred to bank account. Let me give one more example. Say, let's say machine cost is 21 lakh. Life is 7 years. So every year 333 you should transfer. Let's say 3 years over. So if 3 years is over, 3 plus 3 plus 3, 9 lakhs is gone. So out of 21, if 9 is gone, what is the balance left in DGG? Can I say 12 lakh? 12 lakh. So now what is the entry going to be for refund? DGG 12 lakhs, P&L account 9 lakhs, to bank account 21 lakhs. Is that clear? The most important point here, whenever there is a refund of grant, that refund is treated like an extraordinary item. And this item requires special disclosure as per accounting standard 5. And this must be 100% written in the exam. So whenever there's a refund, treat it like extraordinary and give a special disclosure for that. Is that clear? I given two simple questions. I think AS12 is a simple standard. I'm not wasting much time on that. Give a try for this particular question. And if you have any doubt in the question, you can please put it in the comment section. I'll definitely reply for that. With that, we are done with accounting standard 12 revision. Okay, we'll move on to the next accounting standard, A17, and this deals with segment reporting. See, segment is mainly a component of a company or a part of the company. And as per accounting standard 17, there are two types of segment, either business segment or geographical segment. So let's take an example. Let's say you have ITC. This company is into many businesses. Can I say FMCG, tobacco, and they're into hotel business, stationery business, correct? Can I say each of this is called as a business segment? So when I say business segment, what is the meaning of that? It is a distinguishable component. Can I say I can distinguish each component from the other? So it's a distinguishable component whose risk and returns are different in comparison to other products. Can I say the risk associated with FMCG is different from hotel, and risk associated with hotel is different from tobacco business, and similarly stationery business. So to call it as a business segment, the risk and return should be different from each other. Similarly, the segment can be geographical segment. Let's say we have Tata Motors in UK, Tata Motors in India. The company is same, but they are located in two different locations. And because of that, can I say the economic environment is not same now? So the environment in India is totally different from the environment in UK. So because of that, can I say risk and returns are totally different? I hope all of you are getting that. So effectively, there are two types of segment. What are they? Business segment, geographical segment. Now let's say when I have so many segments like this in our example, let's say ITC has some 7 segments. Now when I'm preparing accounts, should we report each and every segment or should we show only the company as a whole? Let's say I have some 20 segments. Can I report each and every segment? It becomes very difficult now. So the accounting standard 17 says you need not report every segment. You should report only important segment. You'll report only what? Important segment. That important segment is what we call as a reportable segment. This is the most important topic here. So important segment is nothing but a reportable segment. Now, how do you say whether it is important or not? For that, there is some quantitative limits. Some threshold is given to that, and you need to apply some individual test. And after applying this individual test, you can decide whether it is important or not important. So totally there are going to be 3 different tests. The first test that I'll be applying is called a revenue test. You need not remember the para number, you can ignore that. Revenue test. What is the meaning of revenue? Can I say sales? And when you're applying the revenue test, revenue means external revenue, also inter-segment revenue. So let's say one segment is selling to some other segment, that is called inter-segment. Even that revenue should be taken for revenue test. So external revenue means sales made to outsider. Inter-segment revenue means sales made within the company. So take both. So take both external revenue and internal revenue. In that you apply 10%. And any segment whose revenue is 10% or more than 10% is called as reportable segment. So that is the first one. What is that? Revenue test. Look at our example. Sir, we have 6 segments. A, B, C, D, E, F. Total all the revenue. Can I say 25, 28, 44, 52, 54, 54 lakh 75,000? 54 lakh 75. In that, if I apply 10%, so can I say 5 lakh 47,500? Now, any segment whose revenue is equal to or more than 547,500 is called as reportable. Now, tell me which are reportable. Can I say segment A is reportable? Right, segment A is reportable. Then segment C is reportable. Segment D is reportable. So which all are reportable? A, C, and D because it's crossing 10%. Is that clear? So when you are applying the revenue test, you should take which revenue? External also, internal also. Take both, apply 10% on that. This is revenue test. Now, the second test to apply is called profit or loss test or result test. So very important here. Here what you will do, first you total the profit of all the profit making segment. Total the loss of all the loss making segments. So separately, don't set off. Profit separately, losses separately. And you take higher of the above. Take higher of the above. In that you apply 10%. And after you apply the 10%, compare that ignoring the negative sign. Ignoring the negative sign. Okay. Profits separately, losses separately, take whichever is higher, apply 10%. Then you compare ignoring the negative sign. Let's take an example. Look at our example. Where all profit is there? Let's say 8 lakh plus 7, 15 lakh, 17 lakh, 20 lakh. So total the profit, how much is the total profit? 20 lakh. Now total the losses. How much is the loss here? 16 lakhs here and 1 lakh, 17 lakh. Take whichever is higher. So which is higher here? 20 lakhs is higher, so take 20 lakh. On the 20 lakh, if I apply 10%, so how much you get? 2 lakh. 2 lakh. Now any segment whose profit or loss, ignore the sign, it can be profit or loss, equal to or more than 2 lakhs will become reportable. Equal to or more than. Now can I say A will be reportable, B also reportable, C also reportable. Don't look at loss, ignore the sign. D reportable, E I should not report, F also reportable. So except E, all the other segments will be reported as per which test? Profit or loss or result test. I hope all of you are getting that. The next one, asset test. Sir, when you are applying the asset test, any segment whose assets are 10% or more of the total assets of the company is called as reportable. But very important point, when you are taking the assets, if you are having any fictitious or imaginary assets like deferred tax asset, that should not be included. You should remove that from the asset calculation. Okay. So these are the three different tests you are going to apply. One is called revenue test. Second one is called result or profit or loss. And finally, asset test. In all the three, we call them as individual tests. So what is the criteria we are applying? 10% criteria. Is that clear? Okay. Now, apart from that, there is something called overall test. See, this overall test will be performed once you complete all the individual tests. You complete all the individual tests. And once you complete the individual test, you'll identify some segments. Now, what does overall test say? Whatever segments you already identified, the external revenue of those segments, the external revenue of the identified segment should be minimum 75% of the overall external revenue of the company. I'll give an example, try to understand this. Let's say we have A, B, C, D, E, F, 6 segments. Out of that, let's say these 2 segments got selected. After applying the individual test, these 2 segments got selected. Okay. Now, let's say the external revenue is 10, 24, 8, 11, 16. Can you tell me the balancing figure? I'm taking the total as 100. So can I say 34, 42, 53, 69, 31? Okay. Now, so let's say if I apply individual test, okay, I'll just change the numbers for better understanding. So let's say total revenue is 100. And segment wise, it's 9, 10, 9, 10, 9, and balancing figure. Can I say 20, 47, 53? Okay. Now, if I apply individual test, let's say I'll apply revenue test. And when I apply revenue test, I'll apply 10% threshold. So 100 la 10%. So can I say 10? So based on that, which all are reportable? B is reportable, D is reportable, F is reportable, B, D and F. And let's say based on result test also, same segments got selected, B, D and F. And based on asset test also, same got selected, B, D and F. So with that, individual test is done. And based on the individual test, what all got selected? B, D, F. Now you need to apply overall test. And when you're applying the overall test is applicable only in case of external revenue. You should not apply overall test for the remaining. Only for which one? External revenue. And the overall test says the external revenue of the segments already selected should be minimum 75%. So in our example, we selected this plus this plus this. What is the total you're getting? 10, 10, 53. Can I say 73? And 73 out of 100 is covering only how much percentage? 73%. But based on the overall test, we should cover minimum 75%. But here is only 73%. So overall test is failed now. Now what the management should do? They can add either A or C or E, whatever you want to add, so that you're crossing that 75% threshold limit. Is that clear? I hope all of you are getting that. Which means the external revenue of the reportable segment should be minimum how much? 75%. If it is not, you should add few more segments so that you comply this requirement. This disclosure requirement is only a story. You can just go through that. Now come to question number 1. Okay, there's a question given to you. Accountant is of the opinion that only M and N are reportable. Is it justified? Let's verify one by one. What is the total assets? 200. In that 10%. So how much is that? 20. So can I say M is reportable? N, O, P, Q. So except R, all the 5 are reportable as per asset test. Now come to result. So as per result test, total the profit separately 50, 60, 70, 100. So total profit is to 100. Total the losses separately 190 plus 10, 200. So profit separately, losses separately, whichever is higher. So I'll take 200. On 200, I'll apply 10%. So how much is that? 20. 20. Based on that, you tell me which is reportable. M, N, O no, P no, Q no, R. So can I say already in the first segment, M, N, O, P, Q, everything got selected. In the second one, R is getting selected. So that way, even if you are qualified under any one test, you are reportable. Which is without even applying the last one, I know that all the segments are reportable. M, N, O, P, Q, R, everything is reportable. But what is the opinion of the accountant? Only M and N are reportable. Justified or not justified? Not justified. I hope you're getting that. Next. Question number 2. XYZ Limited has 3 segments, X, Y, and Z. The total assets of the company is given to you 10 crores. Okay. Now they gave you segment wise. Look at segment wise. Segment X 2 crores. In that, there is deferred tax asset, that is imaginary. So what I should do? Remove. So 2 crores, you remove 0.5. Can I say 1.5 crores? Segment Y, 3 crores minus 0.4, 2.6. Segment Z, 5 crores, remove 4.3, 4.7. Total all this. And can I say 8.8 CR? In that 8.8, apply 10%. So can I say 0.88? Now any segment whose assets is 0.88 or more than that is reportable. Can I say all are reportable? So everything is more than 0.88. So which all are reportable? X, Y, Z, everything is reportable here. Okay. So this is the quick summary of accounting standard 17. Okay. Now let us move on to accounting standard 29. So this standard deals with the provisions, contingent liabilities and contingent assets. See, while discussing AS4, I told you in AS4, what is the title? Contingencies and events occurring after the balance sheet date. But our main focus was only on the events occurring after balance sheet date, because the contingency part is going to be discussed in AS 29. Okay. Now, if you look at this, there are three important words: provision, contingent liability, contingent asset. Now, what is the meaning of all that? So, can I say provision is a present obligation? Because where do you show provision? So, you show the provision on the liability side. So, if you're showing on liabilities side, balance sheet is prepared on a particular day. And if you're showing on the liabilities side, can I say it's a present obligation? And the present obligation should arise from where? Past transaction. However, you don't know the exact amount. You should be able to measure that amount only with reasonable estimation. So there should be a present obligation that should come from past transaction, and you should be able to measure that with a reasonable estimation. That is called provision. And provision is normally recognized in accounts, correct? Now, what is contingent liability? So can I say as of now it is not a liability, it may become liability in the future. So can I say it's nothing but possible obligation, possible. And that arises from where? Past transaction. The result depends on either happening or non-happening of a future event which is uncertain. The best example for that can be any court case. So here I don't know whether the liability is going to come up or not going to come up. And this kind of contingent liability, where do you show? We'll show it in notes to accounts. Correct, Appa? Contingent asset, just opposite of contingent liability, is a possible asset. Not very important. You can ignore that. Clear? Now, see the most important point. Remember this conditions. Very, very important. So if you want to recognize the provision, what are the conditions? First of all, there should be present obligation. Second of that, this obligation should come from where? Past event. The present obligation is a result of the past event. And there should be probability of the future outflow of resources. Okay. Before discussing this, I want you to understand this flow chart. Very important flow chart. Let's say you have a contingency. Okay, you have a contingency. So when I say contingency, what is the meaning of that? We don't know about the outcome. It may be an anticipated gain or anticipated loss. Correct, Appa? So contingency can be anticipated gain, or it can be anticipated loss. Two possibilities. Now, if it is anticipated gain, will you record that in accounts or ignore that? We ignore that as per conservatism concept, ignore that. But if you are anticipating a loss, what should I do? Very important. So if you are anticipating loss as per this standard, you need to look at the chances of losing. So what should I consider? What is the chances of losing? Okay, these chances of losing are classified into three. The first one, very high chance of losing. The very high chance of losing is called a probable. So what is the meaning of probable? There is a high chance that you are going to lose. Second one is called a possible. And when I say possible, it is moderate. Say moderate. What is the meaning of moderate? It's not very high also, it's not very low also. There's a medium chances of losing. And the last possible thing, remote chances of losing. So whenever there is anticipated loss, it can be a probable loss, possible loss, or remote. So probable loss means there is a high chance of losing. Possible means a medium chance of losing. Remote means a low chance of losing. Is that clear? Now, very important. If it is probable chances of losing, very high chance, then only you should create a provision. Create provision. If it is only medium chances, then don't create provision. You just need to disclose it like a contingent liability. Disclose what? Contingent liability. If it is remote chances, that can be ignored. A very important discussion. I hope all of you are clear. So anticipated gain, ignore always. If it is anticipated loss, you have to look at what? Chance of losing. With high chances or medium chances or low chances. If it is probable, make a provision. If it is possible, show it as contingent liability. If it is remote, that can be ignored. Is that clear? Okay. Now, so that is what is given here. So if you want to recognize a provision, look at condition 3. What did I say? There is a probability of outflow of resources. So the loss has to be probable. And what is the meaning of probable? High chances of loss. High chances. Okay. and you should be able to estimate the amount with reasonable estimation. Okay. Now, let us get into a few questions and understand this. Question number one. After wedding in 2004 and 5, 10 people died. Okay. Possibly as a result of food poisoning from products sold by the company. The legal proceedings are started seeking damages. Up to the date of approval of the accounts for the year ending 31st March 5, the enterprise lawyers advised that probability of losing the case is low. So can I say the probability of losing is low, which is the chances of loss is not probable. So if the loss is not probable, it can be either possible or remote, that we don't know, but it is not probable. And if it is not probable, I don't need to create a provision. Sir, I don't need to create a provision, which means on 31st March 2005, when I create my books of accounts, so provision required or provision not required? Provision not required. I'm sorry, there's a mistake here. Rectify that. Provision not required. Why it is not required? Because there is no probability of outflow of resources. So simply I will show it as contingent liability. Is that clear? Okay. However, when accounts are prepared for the next year, lawyer advised that because of development in the case, it is probable that enterprise will be liable. Now the chance of loss is very high. The loss is probable. And when the loss is probable, what should I do? Provision should be made. Why provision should be made? Because there is a present obligation, and that is because of past event. What is a past event? I sold some item, because of that there is a food poisoning, and there is a probability of outflow of resources. So what should I do now? I should make a provision. I hope all of you are clear with the example. Okay. Now, second question. Second question. There is an academy CAPS which has having 50 students of CA Inter. Okay. With guarantee for returning 5,000 if the student does not clear the exam. So the management is promising a refund. If a student failed the exam, you'll give a refund of 5,000. Our assessment puts 60% probability of success. See, when I say 60% probability, 60% pass percentage, sir, how do you interpret that? Is it like every student a 60% chance of clearing, or out of 100 students, 60 will clear? You tell me what is the correct interpretation? So correct interpretation is when I say 60% probability of success, if 100 students write the exam, 60 students will clear. So if 60 students are clearing, can I say the remaining 40 students, the chances of not clearing is very high? Okay, this is one point where students get confused. So it's given 60% pass percent. So it's like out of 100, if 60 are going to clear, the remaining 40 may not clear now. So what is the chances that 40 students may not clear the exam? That's very, very high. Because based on my past experience, I know that 40% may not clear. So the chances of that 40% students not clearing the exam is very high. Which is the loss is probable. And if it is probable loss, what should I do? Create a provision. Create a provision. Now see this. If you look at student wise, no provision required. But the above view is not appropriate. So this is not appropriate. So you have to consider the entire 50 students. Out of 50 students, how many might fail the exam? 40% of that. So 20 students might fail the exam. And for that 20 students, you have to give the refund. How much refund I should give? 5,000. So 20 into 5,000. So how much provision I should make? 1 lakh rupee you should make a provision. I hope all of you are getting that. Okay. Clear? Okay. Let's move on to the next question. Okay. See, Wymood Limited sold 1 lakh vacuum pumps. Okay. During the year with a warranty condition. They have given a warranty. What is a warranty? Either they will repair or they will do replacement in 6 months. So what is the warranty period? 6 months. So within 6 months, if there is a problem, either I'll repair the item or replace the item. Your past experience shows that there were no replacements. So can I say there is no replacement in the past? The chances of replacement is remote. So if it is remote, I'll ignore replacement. However, based on my past experience, I know that there is some minor repair and major repair. So in the past, if there is repair, can I say in the future also that repairs will continue? We see the chances of repair is very high. It's very high. It's a probable loss. Okay. And how much repair is expected? Minor repair 10%, major repair 5%. Now the question is they're asking whether you should make a provision or not. And what is the cost of minor repair? What is the cost of minor repair is given to you? The cost of minor repair is 1,000 rupees and the cost of major repair is 6,000. Now just look at the facts. Just look at the facts. First thing, how many pumps I sold? 1 lakh. Out of that 1 lakh, how much is minor repairs? 10%. What is the cost of minor repairs? 1,000. So can I say 1 lakh into 10% into 1,000? How much you get? 100 lakh. And based on my experience, I know that repair is going to be there. And if repair is going to be there, the loss is very, very high chances probable. So 100 lakh, what should I do? Make a provision. Same way, 1 lakh pumps. How much is major repairs? 5%. So 1 lakh into 5%. And what is the cost of the major repair? 6,000. So 1 lakh into 5% into 6,000. So how much will come? 300 lakh. And this 300 lakhs also, what should I do? Make a provision. So 100 plus 300. So you'll make a provision for 400 lakhs. 400 lakhs. Is that clear? Okay. So I hope all of you are understanding the example that we are discussing. Okay. See, since it's a rapid revision, I'm going at a little higher, faster pace. I hope all of you are getting that. And if you have any confusion, you can always approach me either through comment section. Please. Yeah. Now have a look at question number 4. It's given to you at the end of the financial year, 31st December 17. A company finds that there are 20 lawsuits pending. So there are 20 cases pending which are not yet settled. Okay. And accounts are yet to be approved by the board of directors. The possible outcome is given to you. Okay. See, whenever court cases are given in the question, how do you interpret this? It's given to you. In respect of the first 5 cases, what is the chances of winning 100%? So when I say 100% chance of winning, in every case, there is 100% chance of winning. See, in case of number of students, you have to take them as a group. But whenever court cases are given, each case is separate case. So when I say 100% winning chance, what is the meaning? In every case, 100% chance of winning. If it is 100% chance of winning, can I say 0% chance of losing? So the chances of loss is very, very low. It's called a remote. So what I should do? The ignore. So the first 5 cases I'm going to ignore. Next, look at the next 10 cases. In the remaining 10 cases, 60% chances of winning. If it is 60% chance of winning, can I say there is a 40% chance of losing? Correct, Appa? And if it is 40% chance of losing, that is called a probable loss. Correct now, moderate. So I'm really sorry, not probable, it is a possible loss. Possible. So what is the meaning of probable? High chance of losing. It's not high, just 40%. So it's a moderate chance of losing. And when it's possible loss, should I make a provision for that or show it as a contingent liability? Contingent liability. Now, how do you calculate that? Understand carefully. Now, there is a 40% chance of losing. That 40% is subdivided into 30% chance of low damages, 10% chance of high damages. So there is a 30% chance that I'll end up paying low damage and 10% chance that I'll end up paying high damage. So what I should do now? I'll consider this also. So 30% chances of paying 1 lakh 20. So 30% of 1 lakh 20 will be 36,000. 10% chance of paying 2 lakh. How much is that? 20,000. Add 4. 56,000. So 56,000 is a probable loss or a possible loss? Possible. And if it is a possible loss, what should I do? I show it as a contingent liability. So 56,000 is the contingent liability for one case. And how many cases here? 10 cases. So 56,000 into 10. So how much you get? 5,60,000 will be shown as a contingent liability. I hope you're getting that. Same way, look at the remaining 5 cases. In the remaining 5 cases also, what is the winning percentage? 50. If winning chance is 50, can I say losing chance is 50? So it is 50-50. Even this is called as possible only, moderate. And if it is possible chances, will you make a provision or again contingent liability? Contingent liability. And that 50% is again divided into 30% low damages, 20% high damage. Just multiply that. So 30% into 1 lakh, 30,000. 20% of 210, 42,000. Total is to 72,000 will be your contingent liability for one case. Into how many cases here? 5 cases. So 72,000 into 5. So how much you get? 3.6. This will also be contingent liability. Add both. So 5.6 plus 3.6. 9.2 lakh will be shown as contingent liability. I hope all of you are understanding this. Okay, the answer is given here. But this is a small correction, I guess. 30 plus 42 should be 72,000 into 5, 3 lakh 60, 3 lakh 60, 9 lakh 20 should be your contingent liability. You can just go through that. Okay. Next question. Question number 5. An engineering goods company provides after sales warranty of 2 years. Okay, they are giving 2 years. Based on your past experience, what the company is doing, they are making provision for warranty on the invoice amount based on the remaining warranty period. This is a very important word. Understand that remaining warranty period. So if the remaining warranty period is less than a year, 2% provision. If remaining warranty is more than a year, 3% provision. So what is the main thing I have to see? How much warranty is left? If it is less than 1 year, 2%. If it is more than 1 year, 3%. Okay. Now, how many invoices they have raised? 3 different invoices are given to you. Invoice date is given to you. Okay, I'll rectify this. This is 2012. So invoice date is given to you, and they're asking you find out the provision on 31st March 12, 31st March 13. Also find out the amount to be debited to profit and loss account for 31st March 13. Okay, just make a table like this. Just observe carefully. What is the first question they're asking? What is the provision required on 31st March 12? Invoice date is given to us. Amount is also given. What is the warranty period? What is the warranty we are given? 2 years now. So if the 2 years is the warranty period, when is the warranty going to expire? Just add 2 years. 2 years you add, 2 years you add, 2 years you add. So you'll get a warranty period, expiry date. Now the company says you are creating warranty based on what? A remaining warranty period. Now see carefully. What is your profit and loss account date? 31st March 12. And what is the warranty expiry date? 19 January 13. So from this date to this date you compare. You have to compare from profit and loss account date up to the warranty expiry date. So if you look at this period, what is the remaining warranty period? Is it more than 1 year or less than 1 year? It's less than 1 year. And if it is less than 1 year, how much provision required? 2%. So 40,000 in that 2% create 800. Are you there? So you need to compare from the profit and loss account date up to the expiry date. Okay. Now look at the next invoice. 2012 you sold. So warranty will expire in 2014. Now compare from this 31st March 2012 up to 29 January 14. So what is the remaining period? The difference. Is it less than 1 year or more than 1 year? More than 1 year. And if the remaining warranty is more than 1 year, how much will create? 3% provision. I hope all of you are getting that. And in the last case, if you see, very important, when is the sale made? October. When are you preparing the profit and loss account? 31st March. Which is as on the date of profit and loss account, the sale is made or it to be made? It to be made now. Which is invoice is not a trace. Sale a panala. So if the sale itself is not yet made, so any provision required or no provision for that? No provision. Just add this. So 800 plus 750 plus 0. So how much should I make? 1,550. This is what I should maintain on 31st March 12. Same way, how much should I maintain on 31st March 13? Same table I'm making. Same table. If you look at the first one, invoice date is 2011. Warranty will expire on 2013. What is your P&L date? 31st March 13. So you're preparing accounts on 31st March. So warranty already expired now. So the warranty period is over. Any provision required or no provision required? No provision. So for the first one, no provision. No. Look at the second one. Second one, la, when is the warranty expiring? 29 January 2014. Now you compare from profit and loss account date to the expiry date. So if you compare from that to expiry date, the remaining warranty is less than 1 year. So if it is less than 1 year, I'll create how much? 2%. So 2% of that, 500. And finally, for the last invoice, a remaining warranty, just compare these two, is more than 1 year. So how much I'll create? 3%. Add these two, 3,200. So for the first year, I should maintain 1550. For the second year, I should maintain 3,200. So they're also asking you one more question. How much provision will be debited to the second year? Now you tell me. 1,550 for the first year, 3,200 for the second year. The difference, what is the difference? From 1,550, I should increase the provision to 3,200. So what is the difference you're getting? 1,650. So this is the amount to be debited to the profit and loss account of year number 2. I hope all of you are getting that. So with this, we are done with accounting standard 19. The next accounting standard is 13, that deals with accounting for investment. See, in this, we'll be mainly focusing only on the theoretical part, because the problematic part will be covered as separate part in advanced accounts. So our focus is mainly on the standard part, theoretical part. Okay, so what is the meaning of investment? Can I say any asset you hold for earning interest, dividend, rent, or capital appreciation is investment. So let's say you are buying an investment property, and that building you are giving on rent is an investment. You are buying shares for dividend, investment. You are buying debentures for earning interest, that's an investment. You buy gold for capital appreciation, is an investment. Now these investments are classified into two types, either current investment or non-current investment. See, where it is current or non-current totally depends upon the intention. So if your intention is to hold for less than 1 year, it's current. If it is more than 1 year, non-current. So what is current for one person can become non-current for another person, totally based on what? Intention. Clear? Now, how do you find out cost of the investment? Now, when I say cost of the investment, it is the purchase price that you pay, any taxes directly related to that, any brokerage that you're paying, and all the incidental expenses related to the purchase will be added in the cost. Okay, let's say you're buying shares, purchase price, any brokerage, any share security transaction tax, all the incidental expenses you add it, that will give you cost. Okay, the next topic is very important, carrying amount of investment. And when I say carrying amount, what is the meaning of that? Balance sheet value. So in the balance sheet, how much you will show? See, the carrying amount depends upon the classification of the investment. And as you already know, there are two types of classification, current investment, non-current. So depending on the classification, we will decide how much should come in the balance sheet. Now, so if the investment is a current investment, see, when I say current investment, what is my intention? My intention is to hold for less than 1 year. So if it is less than 1 year, it's more like an inventory. So in that case, I'll value them at cost price or market price, whichever is lower. Whichever is lower. Very simple. This is how I value current investment. If it is non-current investment, so if it is non-current investment, I don't intend to sell. I want to hold it for a longer period. If I want to hold it for a longer period, even if the market price is going up and down, I don't worry about that, because my intention is not to sell it. My intention is to hold for a long period. And because of that, in case of non-current investment, normally they are valued at cost. What is the rule here? Normally valued at cost, because I'm not worried about the market price, because I don't intend to sell it immediately. Normally valued at cost. However, some exceptions are there. If there is a fall in the market price, let's say there is a fall, you need to verify whether it is a temporary fall or non-temporary fall. If it is a temporary fall, so let's say you bought shares of Reliance. Because of the market volatility, temporarily there is a fall in the price. Will you worry about it or ignore that? Ignore now, because again it's going to bounce back. So if it's a temporary fall, that can be ignored. But if the fall is a non-temporary fall, if you feel that the fall is going to sustain for a longer period, then the loss should be recognized immediately. Simple rule, temporary things have to be ignored. If it is non-temporary, then you book the loss immediately. So, but how do you understand whether it is temporary fall or non-temporary? For that, you need to apply your judgment. See, if the fall is because of external reasons, like market sentiment is bad, or US Iran war is happening because of all the shares are going down. So all these are external reasons. So if it is an external reason, then I can say it's a temporary fall. If the fall is happening because of something wrong with the company, so can I say it's because of internal reason? Company is technically like something is wrong with the company, going concern is in doubt, and company is suffering losses continuously. Company is losing all the court cases. So if it is internal reason, then I can say it is a non-temporary fall. So temporary or non-temporary, that you need to decide based on your judgment. Is that clear? Similarly, let's say in the future, if there is a rise in the market, again you need to verify whether it is a temporary rise or non-temporary. If it is a temporary one, ignore. Anytime temporary has to go, ignore. If it is a non-temporary rise, then what you should do? You cannot book the profit, but you can reverse the loss if you have booked any earlier. Now, what is that? Let's take an example. Look at example. Let's say we have non-current investment. What is the cost of it? 8 lakh. Now, there is a fall in the market price. It became 7.8 lakh. Now, if that fall is a temporary, let's say it is a temporary, what I am going to do? Ignore that, ignore. So, I'll continue showing at 8 lakh. But let's say 8 lakh became 7 lakh 60. But now I feel that it is non-temporary fall. And if it is non-temporary fall, what should I do? Book the loss. So 8 lakh should become 7 lakh 60. So I'll book a loss of 40,000. So the entry is going to be profit and loss account debit to investment. So I will book a loss of 40,000. And by booking a loss of 40,000 in the balance sheet, my investment will become 7.6 lakh. Later from 7.6, let's say market price became 8 lakh 10. There is a rise. You need to verify temporary or non-temporary. If it is temporary, what I'll do? Ignore that. But let's say it has gone up to 8 lakh 20, but I feel it is a non-temporary rise. So from 7 lakh 60, it has gone up to 8 lakh 20. How much is the increase? 60,000. But you cannot increase 60,000. You can only reverse the loss booked earlier. What is the loss you have booked earlier? 40. So now when I'm passing an entry, the entry is going to be investment account debit to P&L. You cannot bring it from 7.6 to 8.2. Maximum you can take it back to the original cost, which is you can reverse only 40,000 loss. Is that clear? Okay, this is how you should do carrying amount of investment. I hope all of you understood this. The next one, reclassification of investment. Even this is important theoretically. Now, if you're reclassifying from non-current investment to current investment, then you should value that at cost price or carrying amount, whichever is lower. Just remember that cost or carrying amount, whichever is lower. If you are reclassifying from current to non-current, then you will value at cost price or market value, whichever is lower. A very important theoretical point. I want you to please go through and remember this. Is that clear? Okay, this point you can ignore. It's very simple one. Non-applicability. So AS 13 is not applicable to banking companies, insurance companies, mutual fund companies, all this. Okay, this part you can ignore. So don't apply to banks, insurance companies, and mutual funds. See, let us say I invested in mutual fund. AS 13 is applicable to me. It is not applicable to the mutual fund company. If you invest in mutual fund, for you it is applicable. Just keep that in mind. Is that clear? Now some practical questions we'll quickly go through. My Limited, they're having 200 shares of YZ Limited at 105. So can I say cost is going to be 21,000. And they paid 200 brokerage. So I should add that also. So the cost is 21,200. At the end of the year, the shares are traded at 110. The market price has gone down drastically, 110. At what value this investment to be shown in the balance sheet? It is a question. The question is silent whether it is temporary, whether it is current investment or non-current. Sir, if it is current investment, straight away cost or market price, whichever is lower. So what is the cost? 21,200. And what is the market price? 200 shares into 110. So 200 into 110, how much you get? 22,000. So cost is this, market price is this. So I'll value at 21,200, whichever is lower. Even if it is non-current investment, normally it's valued at cost. So even in that example, so it's going to be 21,200. So current investment also 21,200. Even if it is non-current, 21,200. Question number 2. Rose Limited had invested 500 lakhs in the equity shares of Nose Limited. The realizable value of the shares has come down to 200. So cost is 500, market price has come down to 200. This is because Nose Limited has lost a case of patent. So can I say this is an internal reason? So if it is an internal reason, can I say the fall is non-temporary fall? So if it is a non-temporary fall, will you ignore that or recognize the loss immediately? Should recognize immediately. So from 500, it became 200. So what is the loss? 300 lakhs. So the entry will be profit and loss account debit to investment. So how much loss you should book? 300 lakhs immediately I will recognize because it's a non-temporary fall. Is that clear? Next question. We have an unquoted long-term investment. So the first thing is long-term, non-current. Cost is 2 lakh. The published accounts of the company showed that company is suffering loss. And also the market share is declining. So can I say this in all internal reasons only? And because of that, the market price became 20,000. So now there is a fall. Can I say this fall is a non-temporary fall now? Because the fall is happening due to external reason or internal reason? Internal. Na? So therefore, this is a non-temporary fall. So what should I do? Recognize the loss immediately. So what is your loss? So 1.8 lakh. So the entry will be P&L account debit to investment. The difference. What is the difference? 1.8 lakh. I should recognize the loss immediately. Is that clear? So these are the main concepts in accounting standard 13. And here we have focused mainly on the theoretical part of that. Yeah, we'll move on to the next accounting standard, AS5, which deals with net profit or loss for the period, prior period items, changes in accounting policies. Okay, we'll take up the topics one by one. See, when you're finding the profit or loss, the net profit or loss for the period may come from ordinary activities or extraordinary activity. Correct? So if if you're getting any profit or loss from the ordinary activity, what is the meaning of ordinary activity? Which happens in your regular business, regular course of business, that ordinary activities do not require any special disclosure, correct? So if the profit is coming from your normal business, do not require any special disclosure. However, sometimes even though it is ordinary activity, due to the size of the transaction, due to the incidence, what is the meaning of incidence? Impact on the decision making, or due to the nature of the transaction. I want you to remember these three words: size, incidence, and nature. So even though the activity is ordinary, because of the size involved, because of the impact, and because of the nature, these require special disclosure. And such kind of items are called exceptional items. So exceptional items are ordinary only, but even though they are ordinary, they require special disclosure because of size, incidence, and nature. Some examples I gave you for that. You can just go through that. Any profit or loss on sale of fixed asset. So if you're selling a fixed asset, you might get profit or loss. So that is non-recurring activity for you. But even though it is non-recurring, you cannot call it as extraordinary. It is ordinary only, but it is an exceptional item. Same way, some more examples I gave you. Profit or loss on long-term investment. If you're reducing inventory from cost to NRV, you're reducing the inventory from cost to NRV. That is also exceptional item. If you're reversing any provision, exceptional item. Any legislative changes having retrospective application. So all these are examples for exceptional item. And if these are exceptional item, requires special disclosure. So what should I disclose? The nature and amount of the exceptional item should be disclosed in such a way that the impact can be clearly understood. Okay. So remember the example that I gave you. So all the exceptional items are ordinary only, but they require special disclosure because of the size, incidence, and nature. Okay. Let us move on to extraordinary item. Now, what is extraordinary item? Can I say these are the items which are clearly distinct, clearly different from your ordinary activities of the business? And if it is extraordinary, without any doubt, the nature and amount should be separately disclosed. Correct? You have to disclose that. Some examples I gave you: attachment of a property. Let's say you are losing a court case and your property is confiscated by the court. That is what is called attachment of a property. And similarly, any loss due to earthquake, any refund of government grant, all these are what? Extraordinary item, and they require special disclosure as per accounting standard 5. So with that, we are done with the first part of the standard, net profit or loss for the period. Let's move on to the second part, a prior period item. Now, what is the meaning of prior period item? You should understand the definition carefully. Prior period item refers to any item of income or expense. So what is the first important word? Income or expense, which occur in the current year profit and loss account as a result of error or omission. What is important? As a result of error or omission in the prior periods, which is if any item is coming in this year P&L because of what? Error or omission in the previous period, then it is called as a prior period item. Okay. And if it is a prior period item, the nature and amount of that should be separately disclosed. What is the meaning of that? Let me give an example. Let's say there is one employee in the company and we feel that that employee was involved in a fraud. So what we have done, we have removed that person from the company on 31st of December. So removed. So removed from the service. And after removing this employee, this fellow goes to the court. And in the court says that employee is not on fault. There is no fault of the employee. So he was removed from the company without his fault. So the court is asking the company to take back the employee. To take back the employee from 1st April 2025. So he's taken back into the company. Taken back. Year ending 31st March 26. And the court is also giving a judgment saying the employee has lost 3 months salary na January, February and March. So the court is telling the company to pay not only this 12 months salary but also to pay this 3 months salary. Now in this example, totally I'll be paying how many months salary? 15 months. And out of 15 months salary, 12 months salary is related to current year, 3 months salary is related to last year. Can we call that 3 months salary as a prior period item? Yes or no? No, because to call it as a prior period item, that should occur in the current year as a result of what? Error or omission. But in our example, there is no accounting error or omission. You removed the employee because of fraud. Later, because of the court decision, you are paying the 3 months salary extra. So that cannot be called as prior period item because there is no error or omission. I hope all of you are getting that. Which is to call something as a prior period item, it should be because of either error or omission. Okay. Next, changes in accounting policy. So if you're changing an accounting policy, you can change in 3 cases: required by law, required by accounting standards. For better presentation, you can do that. And whenever you change an accounting policy, you need to verify if there's any impact on the profit. Sir, if the impact is measurable, you should quantify the impact and also disclose that. If the impact is not measurable, you are not able to measure the impact, then you should only disclose. You cannot quantify, you just disclose the fact. So measurable, quantify, disclose. If it is not measurable, don't quantify, just disclose that. Is that clear? Next, change in accounting estimate. See, when you are preparing account, there are a lot of estimations involved, correct? Like provision for bad debt, provision for discount, provision for tax, provision for warranty, etc. And these estimations can change, na? So estimations will not remain same. Estimations can change. And when estimations change, the profit or loss also will get affected. So you need to verify because of the change in estimate, whether there is any impact on the profit. And if there's any impact on the profit or loss, you need to quantify that and disclose that. Is that clear? Okay. Now let us identify the following. You need to identify whether it is ordinary item, extraordinary item, prior period item, change in a policy or change in estimate. First one, arrears of previous year's salary paid in this year. Okay. Due to omission, let's say, due to omission. So previous year you omitted a salary, now you are paying. So can I say that's a prior period item? Next one, insurance claim received. Can I say that is extraordinary item? Loss by earthquake, extraordinary item. Change in the method of depreciation. In AS10, I told you, if you are changing the method of depreciation, that is like a change in accounting estimate, not a policy, it's a change in accounting estimate. Change in life of the asset, that is also change in accounting estimate. Salary not accounted last year, accounted in the current year. What is that? Prior period item. Okay. So I've given a brief summary of accounting standard 5, not a very important standard from examination point of view. You can just go through whatever I've discussed. Is that clear? So with that, we are done with accounting standard 5 summary. Let us move on to accounting standard 11. So this standard deals with accounting for effects of changes in forex rates. Now this standard I'll be dividing into 5 topics. Topic number 1, what is the meaning of monetary item and non-monetary item? See, as per the AS11, if you want to call anything as a monetary item, it has to be an asset or liability which is expressed in fixed determinable amount of receivable or payable. Three important words here. So first, it should be an asset or liability. You should be able to express that as a receivable or payable, and the amount should be a fixed determinable amount. If all the three conditions are satisfied, you call it as a monetary item. If not, it becomes non-monetary item. Now look at the example. You need to identify whether it's monetary or non-monetary. First one. See, if you look at land, it's an asset for you. So even though it's an asset, you cannot express land as a receivable. So therefore, land will be a non-monetary item. Same way, goodwill. It is not a receivable, non-monetary item. Can I say debtor is asset and you can express that as a receivable? So debtor will be monetary item. Creditor is a liability which can be expressed as payable, monetary item. Bills receivable is asset, receivable, monetary. Bills payable is liability and payable, monetary. Commission received. Commission received is an income. And incomes cannot be monetary item. This has to be non-monetary item. Accrued expense. What is that? Expenses payable. So it's a liability which is expressed in payable. So this is monetary item. Accrued income. Income receivable, monetary. Any loans given. So can I say loan given is an asset and it's a receivable for you. So because it's an asset and receivable, monetary. Loan taken, liability and payable, monetary. Provision for tax. Now provision for tax, even though it is a liability for you, you cannot express in a fixed determinable amount because provision is only an estimation. You cannot express as a fixed amount. Because of that, a provision for tax will be non-monetary item. Is that clear? So with that, we'll complete topic number 1. So you should know the definition of monetary item. Is that clear? These are the 3 important words. Remember that. Okay. Moving on. Topic number 2. How do you do accounting for foreign currency transaction? So we'll be applying 3 rules. So when you're accounting for a foreign currency transaction, first thing, on the date of transaction, when the transaction takes place, the initial recording will happen using whatever is the exchange rate on the date of transaction. Okay, look at the example. So in our example, you made a credit sale. What is the date of transaction? 27 March. $25,000, and what is the rate on that day? 76 rupees. So what is the journal entry when you make a credit sale? Can I say debtor account debit to sales? So record that $25,000 and that will be recorded at 76. So can I say 25,000 into 76, 19. Okay. So this is rule number 1. So recorded taking whatever is the rate on the date of transaction. Next. Then what I should do on the date of balance sheet, if you find any monetary item, that monetary item has to be restated. What is the meaning of restating? You have to recalculate that using the closing rate. Now look at this. In this journal entry, we have a monetary item. What is a monetary item here? Data. And this data has to be recalculated on which date? Balance sheet date. Now in our example, what is the balance sheet date? 31st March. So on 31st March, your data has to be restated from 76 rupee to 78 rupee. So which is, can I say, data is going up? Data is going up now from 76 rupee. I should increase it to 78 rupee. So if data is going up, can I say data will be debited? So $25,000 into 2 rupees. So how much is the going up? 50,000. And if asset is going up, can I say it's a gain for me? So that I'll transfer to exchange gain account, which will again go to profit and loss account. Is that clear? So debtor account debit to exchange gain. So now read rule number 2. So on the date of balance sheet, if you have any monetary item, you need to restate that using the closing rate. And any difference will be either loss or gain for you, which will be transferred to P&L. Okay. Next. Now can I say the debtor value will become 19 lakh plus 50,000. So what is the balance sheet value? 19 and a half lakh. Now on the date of settlement, if settlement happens on a later date, the difference between balance sheet value and settlement value will be loss or gain for you. Now, what is the balance sheet value of debtor? 19 and a half lakh. Now, 11th April, we are getting the collection. We are collecting the payment. So, what is the entry when you get the money? Bank account debit. So, bank account debit, how many dollars? $25,000. And on the date of settlement, what is the exchange rate? 77.3. So, calculate that. So can I say 25,000 into 77.3? So what is the collection? 19 lakhs 32,500. This is the settlement value. To debtor account, what is the balance sheet value? Can I say 19 lakh plus 50,000, 19 and a half lakh. So in the balance sheet, it is 19 and a half. But you are collecting only 19 lakh 32,500. So can I say you are collecting lesser amount? And if you are collecting lesser amount, that is going to be exchange loss, which will be transferred to profit and loss account. Balancing figure 17,500. Is that clear? So initially you record whatever is the rate on that day. Balance sheet date you restate. Which will you restate? A monetary item. Take the closing rate and restate. Any loss or gain, put it in P&L. Finally, when you are doing settlement, difference between balance sheet value, settlement value, that difference will go to either loss or gain and directly to P&L. Is that clear? So this is how you do accounting for foreign currency transactions. Clear? Yeah, that's all for today, guys. In today's video, I've tried to cover 12 accounting standards. Please revise all this. Wish you all the best for your exam. And in the next video, I'll try to cover the remaining accounting standards. So stay tuned for that. Thank you.